This entire economic cycle has felt like it's been on fast forward.
All this talk about a recession so far hasn't panned out.
This current correction is not about growth fears.
What I see is a pull forward of consumption.
We are expecting that both Fed and ECB will stay on hold next month.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get your week started live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market positive by 0.5% on the S&P 500. 4-day losing streak coming into this week. The main event taking place on Friday. TK, Jackson Hole and Chairman Powell just around the corner.
And we said you get closer to it to really have an understanding of what Jackson Hole is going to be this year. And I think we're closer to it. I think Dr. Alarian, who we're going to get a lot from today, really summed it up as a 3-frame what if. And that's how many things, that's how many moving parts are going on. I'd like to suggest we'll have a clarity of thought by Thursday before Friday.
Welcome back, TK. Good to see you.
I have. Can we say who I have to say thank you to?
Sure. Who do you want to say thanks to?
Abelardo Aguiar was a Philippine doctor who invented erythromycin. He's the one that figured out the wonder drug. And so, it's good to say thank you to he and Eli Lilly.
Do you want to offer a little bit more detail than that?
I had the plague.
Okay, good.
The plague.
Welcome back, Tom.
I had pneumonia.
Okay.
And everybody was great, and I'm down, and, it's sort of it was like a vacation.
We've got to look after you.
That was my holiday.
I'm not sure people would describe that as a vacation.
That was my holiday for the year.
Okay,
Sorry.
well, we've missed you, and it's great to have you back with us to try and work out if we've got any clarity on a range of issues, including this morning, Lisa, China. Some confusion, I would say, through last week on the policymaker out of the world's second largest economy, and that confusion continues this morning.
They did not cut 5-year rates. They cut 1-year rates, less than expected. And this goes to this question, are they not stimulating more because they don't want to inflate a bubble, because they want to support the banks, or because they can't? And this is the question, as everyone says, if they want the Chinese economy to actually get its feet back under it, they need something more substantial that just isn't coming yet.
But I would overlay China and all the confusion, as John mentions, right over to Jackson Hole. The mathematics of this, which is out on Twitter, it's out there among the academics, is the convexity of it, the acceleration of trends right now that we've seen over the last 10 days. And I'm going to call it right now, it's a log convex Jackson Hole. That's mathiness for acceleration. Things are moving suddenly. And I'm sorry, Beijing is in Jackson Hole here on Friday.
You've missed quite a bond market move, Tom.
Unbelievable.
Over the last week. Let's get the screen up. Let's get to the markets. TK, when you left and now you've come back, these yields, 430 on a 10-year, looking at highs we haven't seen at the close since 07, on a 30-year back to 2011. Some serious levels.
First thing I did today is I looked at the real 10-year yield, the inflation-adjusted 10-year yield, and suddenly at 2%, 1.98%. And it's simple, John. There it is, almost back to where it was Jackson Hole of 2007. And you say, okay, Tom, what's a fancy number? It's 2.05, but actually 2.22. We're not yet to June and July before the crisis of 07, but boy, have we gotten there quickly.
This is real rates, not nominal, Tom.
Real rates, which is how the adults think. I mean, I'm sorry, they work in a real rate world, even though the rest of us are looking at, what, Lisa, 7.60 was the bank rate 30-year?
Well, there are different ways of measuring the mortgage. I'll just say that when you take a look at a range of different yields, whether it's nominal or whether it's real, you're seeing some of the highs going back 15, 16, 17, 18 years. And there's a question of, is this the new normal, even if inflation gets under control? And that's a key question at Jackson Hole.
Yields are up this morning by 5 basis points or so on a 10-year in the equity market. A lift here on the S&P 500. Bramo, equity futures positive by 0.5%.
The week really starts tomorrow. Some would say the week starts Friday, but I would say the week starts tomorrow. So I'll give you a sense of what we're looking for. Tomorrow is the beginning of the BRICS group, Brazil, Russia, India, China, and South Africa meeting in Johannesburg, South Africa. Very interesting in light of China and how much they're pushing to really create a rival to the G7 and what they try to get. Why are you shaking your head, Tom? This is the question.
First of all, Jim O'Neill's photo ought to be up there with him. I mean, come on, Putin can't even go.
Right.
Because he'd be arrested.
Correct.
But what really upsets me, and The Economist, I thought, grabbed this nicely in the last 24 hours, there's like divisions of BRICS. There's basically China, who really wants to get this done and expand it out, and everybody else is like, Am I right?
Well, it depends on who everybody else is. There's this question around India, which is trying to cement its connection with the U.S. We can go into the whole discussion, but they are trying to adapt to a larger group. We will talk about that. Wednesday, we're also going to be talking about Nvidia reporting earnings. Also, the Republican primary debate in Milwaukee. We could see Nvidia. The question here is, how is the market going to respond? Perhaps more than what the earnings actually showed on Friday. It is going to be about the Jackson Hole Fed Symposium. Fed Chair Jay Powell coming out at 10 a.m. Eastern. ECB President Christine Lagarde will be there. She will also be speaking. To me, I want to understand whether he takes up Mohamed El-Erian's point and doesn't talk about anything substantial and basically just goes after some esoteric economic debate, which is sort of not in his purview because he's not an economist by training, and just goes after something less consequential, but that sounds like it has gravitas.
I'm on the same page as Mohammed here.
I know.
As I've talked about over the last couple of weeks. Do no harm, Tom. First course of action. Do your best to say nothing. There's a suggestion, though, that he's going to say something. I'm not going to say he's going to say this, but Jason Furman in the Wall Street Journal
has been on fire.
We'll discuss this a little bit later this morning. Raising the prospect of further down the road, not now, further down the road, Tom, tolerating something just below 3% on CPI, then a few years later maybe formalising that as the new price target.
You know, I don't want to steal time here from Luke Call. We can do this through the show this morning here, but we really need to frame out, folks, for you, this debate between getting back to 2.x% or even below that versus 3.y%, whatever. But that debate needs to be framed out through the week.
Luke Howard's with us now, asset allocation strategist over at UBS Asset Management. Luke, wonderful to get you on the programme with us to kick off a new trading week. Luke, I know where you stand on manufacturing coming up to services. For people who haven't followed the global economy over the last several months, services is still okay, stateside, manufacturing just a little bit softer. You're expecting manufacturing to actually converge up to where services is now. Luke, how would you reconcile that with what's developing over in China?
So I think we'd certainly say that what's happening in China is a challenge to that thesis. Most certainly, if you look at the two defining kind of global forces in the global economy over the past 15 years, it's been one that everyone, pretty much the same thing happened after the financial crisis with household deleveraging as a common factor. The second common factor was global goods cycles being driven pretty much by the China credit cycle completely. We're now heading into a world, we think, where those two potent forces are no longer going to be kind of the driving forces of both goods cycles and economic ebbs and flows in general. That means, as macro strategists, we have to be looking for some of these new connections that are going to be driving that. And right now, we think that the real income side and the inventory restocking side, particularly in the U.S., is what's going to drive more of a convergence of manufacturing towards services.
Look, while I was in the hospital flat on my back, John would brief me every day about 4 p.m. And John, one of the days, mentioned the equity market really hasn't pulled back all that much. Do you see an equity market that's been resilient given the bond carnage?
Certainly, and one thing that really stands out is how kind of rational or orderly a lot of the elements of the sell-off is. If you look at a kind of basic screen of what's done the worst, it's been rate sensitives. We all know that story. It's been China sensitives, and then it's been more speculative pockets of the market. So that to me says that this isn't yet about any kind of growth slowdown, pricing in the risk to growth from a term premia shock from what we're seeing in China. That doesn't suggest that that's manifest yet. And the one thing we continue to hang our hat on is global growth estimates are up 60 basis points since the start of the year, and they're up 20 basis points even since Chinese data started rolling over. So that tells us that a lot of the strength in earnings we expect to keep the bull market powered forward. It's somewhat been cushioned even amidst the kind of economic pain in the manufacturing side and in China that we're seeing recently.
So how much are you paying attention to Jackson Hole, Luke, and the potential for some sort of acceptance of higher inflation and higher rates for a longer period of time?
Certainly that message of that you alluded to from Dr. Furman about the potential de facto higher inflation target, do not think you'll get a sniff out of that at this Jackson Hole in particular. And quite frankly, I don't think you can get a sniff of that till you've touched 2% on the dot at some point going forward. The message we expect to hear from Chair Powell is actually pretty similar to the one that was detailed in the minutes. And it's honestly, it only differs in tone and in kind of starting point from the message we heard last year. Last year, the message was simple, short, direct. Inflation's too high. We're going to need economic pain to get inflation down. This year, we've had the inflation come down a lot of the way without much of the economic pain. But the Fed is still saying that a period of below trend growth is going to be necessary to get, that quote unquote last mile of inflation or the sustainable inflation on target. And, our view is that that's going to be, somewhat reinforced. And the danger, or what the market could be looking for, is the 2024 dots, the 100 basis points priced in. I think the market has about 40 basis points priced in more than the Fed right now. The danger is that with growth so resilient, the Fed shouldn't be showing as many cuts in 2024, even as inflation has come down under that operating framework. So I don't know if that's something that you can allude to in this. I don't think you're going to get a very academic kind of view on r-star here. It's just going to be the Fed's willingness to keep rates higher for longer in order to make sure that last mile takes place.
Luke, when we take a look outside of the world of Jay Powell and we look at what the main market drivers have been this year, it really has been China. Earlier in the year, you were a little bit more constructive. Have you shifted your view in light of the lack of policy response that we have seen consistently out of the Chinese Communist Party?
In a word, yes. So we've shifted our views on China to be more neutral for several months now. And right now, I think the kind of juxtaposition, or how we're weighing it and thinking about it, is there's no catalyst on the horizon that suggests that there's going to be kind of a sudden shift, an abrupt turnaround. And in fact, it's not just the magnitude of the stimulus, but it's also the nature of the stimulus. It's very kind of more supply side oriented, driven in terms of the measures being delivered. And that, whether you're in a liquidity trap or whether you're in a balance sheet impairment on the private side, those kind of measures aren't going to be the most efficacious. So we've changed our view on that. But on the other hand, we do have to appreciate that when valuations are this low in China and sentiment is this negative, that tends to be the starting point for pretty fertile rallies to the other side. So it's balancing that kind of view that on the macro side, it's really hard to pick out a reason to be constructive, but on the valuation side, it's right. Kind of very dangerous to be shorted.
Luke, it percolates, frankly, always percolates the third week of August. What's the short cover ability here right now? We've been pretty beaten up. I mean, the numbers aren't all that big on a drawdown, but there just seems to be a lot of betting on gloom. What's the short cover potential?
So if you mean the short cover potential on equities, I would say that kind of our view is that heading into the last leg of the rally that got us to effectively year-to-date highs, that was the normalization of positioning from pessimistic levels to kind of more normal levels. So I would say on the equity side, the positioning is a little clean. What's a little more worrisome in terms of the short covering side is that from the surveys we've been looking at, it seems that there is very much an itch to buy duration and to kind of call the top on yields. That's the position that seems like it's been getting squeezed a little more lately, particularly given it's August, the low liquidity situation. And that to us is the scariest thing about the bond market. It's the degree of momentum that yields have to the upside.
Bob Michael at JP Morgan Asset Management, feeling that itch. Luke Cower. Luke, it's good to see you, as always. Have a good week, buddy. Luke Cower there of UBS. Coming up very shortly, we'll catch up with Wendy Schiller of Brown University, and we're going to be talking about this poll out from CBS over the weekend. The former President Donald Trump with a massive lead for the GOP. Tom, this question here stood out for so many people, and if you're not familiar with this, haven't seen it yet, allow me to give you a sneak peek of this poll. Who do you trust to tell you the truth is essentially the question they asked possible Trump voters, Tom. 71% said Trump, 63% friends and family. 71% Trump, 63% friends and family. So basically, Trump supporters trust Trump potentially more than their own family members, Tom, to tell them the truth.
Yeah, well, this is what's important here is this is Anthony Salvanto's legendary at CBS. He's been huge in the poll business for years. So if you start with the idea it's a real poll, and the answer is there's a lot of information here into the debate, and it enriches all the ballet of this debate that we're going to see here.
It's a monster lead, and we're told he won't be at that debate this coming Wednesday. A preview coming up next with Wendy Schiller on the equity market a little bit later. Julian Emmanuel of Evercore in the next hour. All of that coming up and more. Live from New York City this morning with equity futures positive. Good morning.
I served alongside the president for a long time, and one thing I realized about him is it's not over till it's over. So
right.
I'm actually still hoping he shows up. I think every one of us that have qualified for that debate stage ought to be on the stage, be willing to square off, answer the tough questions, and also draw a bright line contrast.
The former Vice President Mike Pence speaking on ABC over the weekend, going into that first presidential debate for Republicans taking place on Wednesday. The latest information we have from the former president, he won't be there, TK. The latest poll we have from CBS YouGov, this one right here with a dominant lead for the former president. TK, 62% of likely GOP primary voters going with the former president. The second place lead, 16%. So DeSantis at 16, then you've got Ramaswamy at 7%, Pence at 5%, who you just heard from, and the rest just single digits, low single digits.
I talk to Margaret Brennan every week, and the wonderful job Face the Nation does for Bloomberg Radio in the afternoons on Sunday. And John, Anthony Salvanto does much more than the poll. I want you to bring in Wendy Schiller because, frankly, you're more up to speed on this than I am. But one of the Salvanto panels, top reasons for considering Trump. Things were better under Trump, 99%. And this one, I think, is the emotion of it. Fights for people like me, 95% in the poll. This is a personal, may I say, crusade that this poll captures, that CBS captures perfectly.
Wendy Schiller of Brown University joins us right now. Wendy, wonderful to start our political coverage this week with you going into that debate on Wednesday. What is the argument for the former president showing up with polls like this one?
Well, I mean, it's a rose garden strategy as an incumbent, quote unquote, in the Republican Party. So it's hard to argue he should show up with such a big lead. But you don't want to, not be there to volley off your criticisms. And presuming Chris Christie is going to show up ready to fight and sort of make the argument that Trump is not the guy, then, that's just criticisms that can stick. The other question is, will any of the other candidates actually criticize Donald Trump on that stage? It's like criticizing a ghost. Remember, Clint Eastwood's sort of stunt in 2012 for the Republicans at the convention with an empty chair. That didn't work very well. So I think Trump knows that. He knows television. He knows how things resonate. And he figures it's much harder to attack him if he's not physically there.
Wendy, a pregnant question, if I may, into this debate and the start of the political season. William Jennings Bryan, there's a lot of parallels here, and it was gold and silver, 1896 and all that. But the answer is, after William Jennings Bryan, the Republican Party retook the high ground, the East Coast business-oriented agricultural party, if you will. What happens after Trump? I mean, with this dominance that he has, what's the next?
Well, I mean, I think that there are people waiting in the wings. I think like Tim Scott, for example, from South Carolina, is trying to craft a message that builds on this evangelical base, that builds on the sort of conservative voters, particularly in the South, that seem to really love Donald Trump. So I think there are people who can then take the mantle. We've also got Chris Sununu of New Hampshire. We've got Brian Kemp of Georgia that I'm keeping an eye on for 2028 if Trump doesn't, he can't run again, presumably if the Constitution holds, so if he wins. But 2028, you've got some Republicans now that are in line, that are lining up. And they seem, frankly, more compelling in a lot of ways than the current lineup of challengers to Donald Trump.
Which raises a question of who really is the number two if Ron DeSantis is increasingly getting pushed out. Over the weekend, he made this oblique reference to Trump followers as listless vessels. And it's sort of getting compared to the whole concept of deplorables. Is it looking more and more likely that he is not really the number two? He is not one of the main contenders when we actually head and get closer to the actual presidential election?
Well, I think Ron DeSantis has the most to gain and the most to lose from Wednesday's debate. Can he get out there and, project a coherent message for the Republican Party saying, I'm the future? Trump's the past. I'm the future. I can win. I know what I'm doing. I'm quite popular in Florida. Can he actually make that argument? If he does it well, then I think he, keeps his post as the second in line. But if he doesn't, and someone like Tim Scott emerges as an attractive candidate, you might even see Donald Trump offer Tim Scott the vice presidency in a month. I mean, Donald Trump doesn't play by the traditional nominating rules, right? So, and that's a tough ticket. That is a very tough ticket.
Wendy, this field is already deep, and yet already we're asking, who's next? Who's going to join him? There was a report over the weekend that maybe Mr. Murdoch had a conversation with a certain Glenn Youngkin. Wendy, what's the prospect of that governor getting into this race?
I just, Glenn Youngkin is a perfectly reasonable politician who won against, a person who had been governor already, who wasn't super popular in Virginia, kind of a little bit of a fluke. And he's also made parental rights one of his big messaging. And you can see it's starting to backfire a little bit on DeSantis because people are focused on the economy. So what has Youngkin done for the economy in Virginia? I just don't see on a charisma level that he can go anywhere close toe-to-toe with Trump.
Wendy, to the other side, what should be the to-do list for the president and the people surrounding the president? Basically, what I see is silence. What should they be doing?
I do think that President Biden emphasizing the economy and understanding that the election is, 14 months away. That's a long time. We can all go back to George Herbert Walker Bush. It was pretty popular in 1991 and then lost in 92 for all sorts of reasons. So I think that's one thing, the long view. But the second is he's got to engage. He's got to engage Trump. He's got to remind people what life was like under Trump and the chaos that ensued. And he's got to appeal to independent voters today, now, going forward, not just the party base, but independent voters as well. And just hammer home and engage and not ignore. I don't think you win when somebody's out there getting a lot of press, very well-known person who has a loyal base. You've got to go after him, just like the people in the Republican Party have to go after him.
Do you think that Kamala Harris has solidified herself enough to really gain the traction in perhaps a younger way that many people said was necessary to give Biden's campaign a little bit more traction?
It's a very complicated situation with Kamala Harris. African-American voters are loyal, and a huge supermajority of African-American voters vote for the Democratic Party. They also are key in places like Georgia and Wisconsin and Pennsylvania and Michigan to winning the presidency for the Democratic Party. So I can't see Biden making a change per se, unless it was to another African-American politician, like, let's say, Raphael Warnock. Do you trade the Senate for perhaps, a guaranteed victory in Georgia, and then find something else for Kamala Harris to do? That's a tough proposition. And remember, the House has to approve another vice president. She can't step down because Kevin McCarthy won't approve another vice president. He's third in line to the presidency. So it gets very complicated in an age where the typical norms, don't apply.
Hey, Wendy, thank you. Good start to the week. Our political coverage continuing. Going into that first debate on Wednesday, Wendy Schiller there of Brown University. There's so many interesting snippets in this CBS YouGov poll from over the weekend, Tom. Should they go after the ghost on the debate stage on Wednesday? A question that Wendy just asked. Of the likely GOP primary voters, who should the president's opponents focus more on? Make the case for themselves? 91%. Make the case against Trump? 9%. That's a pretty big divide there, TK.
It's interesting here, as you go from the beginning of all this, Falter, in August of this year, into next year, how many debates do we get in? How many primaries do we get in to where they shift from a very Trump-dominant focus over to, okay, we've got to get elected? I'll let somebody better than me. Anne-Marie Horton can answer that question better than me.
You're right. How do you pivot from primary to the general, right? And that's been a consideration in the primary. Well, you got to win the primary first, and this is sort of the rub. I'm wondering what Trump is going to do. He said that he's going to be potentially interviewed by Tucker Carlson. He has not confirmed that. We haven't really heard any confirmation from X that that's going to be the platform of choice. There is a question about whether Fox News still has a contract with Tucker Carlson that would prohibit him from counter-programming. There's so many really intriguing questions around that whole situation.
I'll be watching Wednesday. I'll watch the debate Wednesday regardless of what the former president does.
Watch it for me.
And I'll watch the debate on Wednesday evening because I'm more interested in the new stuff from the other candidates we haven't heard of.
I think.
Are we actually going to hear anything new from the former president if he tries to counter-program? That's just my opinion on what I'll be doing on Wednesday evening.
On both sides of the aisle, people are starving for something new. I really agree with that, with the Democrats and the Republicans.
The problem the other candidates have is they need to make some inroads with the Trump supporters who won't be watching that debate and will probably be watching the former president. But there we go. Yeah. Coming up next, Bill Lee of the Milken Institute on China as policymakers continue to confuse investors worldwide. Equity futures on the S&P 500 positive here by 0.5%. Live from New York, this is Bloomberg. Four-day losing streak on the S&P 500, attempting to prevent it becoming 5. Your equity market with a lift here on the S&P after a pretty flattish close on Friday's session. In the equity market this morning, up by 0.4% on the S&P. On the Nasdaq right now, up by 0.6%. The Nasdaq on the month. On the Nasdaq 100, Tom, we're down 6.7%. Pretty brutal stuff for the month of August.
I mean, I was tearing up here. We will talk about Harry Kane later. I was tearing up, John, this weekend watching him with Bayern Munich. But while I was doing that, I was looking at the drawdown, and you were on the phone with me briefing me because I was out of touch. And the answer is, I mean, I'm sorry. Equities really, I mean, come on. With all the gloom that's out there, August drawdown from the peak. SPX down 5. You mentioned 6, 7, whatever it is now. Down -3. NASDAQ -7. Those aren't even corrections.
If you told me where the bond market would be, Tom, over the next month, and you said we'll get to these kind of levels again, I'm with you. Perhaps I would have expected some more damage on the likes of the S&P 500.
Yeah,
30 basis point move in the last month, over the last few weeks on a 10-year yield.
I was thunderstruck. I looked at Nvidia, which I've frankly never looked at in my life, and it's barely pulled back here. I mean, it's got a little bit of a pullback. Microsoft's more Apple, some of those names, but
earnings from them.
What does Nvidia do?
Earnings from them in a couple of days. We'll talk about that later, Tom. In
I
a
was
bond
tearing
market,
up on the break.
2-year, 10-year, 30-year, some really interesting levels over the last week or so. If you've been at the beach, welcome back. A 30-year yield. A 30-year yield that we haven't seen for the best part of a decade. A 10-year yield at the close last week that we haven't seen going all the way back to 2007. Lisa, 429.82 on a 10-year. On a 30-year, 443. Hello, up 6 basis points.
And we've been talking about what's driving this at a time where we're going to have a couple of auctions this week on a quiet week ahead of Jackson Hole. Should be interesting. 20-year auction on Thursday. Here's the question. Is this being driven by higher inflation expectations or by a higher premium expectation that basically people are going to demand more to lend to the United States because of the deficit and the lack of really fiscal restraint that we've seen even during a period that has been strong?
Higher so-called term premium has been a part of the conversation. Let's turn to foreign exchange just to wrap it up for you. On a euro, just short of 109 at the moment, 108.94 on that currency pair, positive by 0.2%. Under surveillance this morning, counting down to Jerome Powell's speech at Jackson Hole on Friday morning, 10:05 Eastern Time. Former National Economic Council Deputy Director Jason Furman, writing in the Wall Street Journal, in the short run, the Fed should be aiming to stabilise inflation below 3%. If it can achieve this goal, then it should shift to a higher target range for inflation when it updates its overall strategy around 2025. This is so controversial, so divisive whenever this topic comes up. I remember when Mohammed Al-Arian floated this a couple of months ago, and he asked the pretty simple question, Tom. If we all got around a table today and said, what is the appropriate inflation target?
Right.
Would we come up with 2 or would we come up with 3?
They had a symposium in Dallas for John Taylor of Stanford years ago, and they actually agreed that they weren't even at 2%, they were sub 2%. So the idea of getting back to 2% is a big deal. And then you engage the debate, and there's a lot of mumbo jumbo on our side. What I would do is listen to experts. Richard Clarida owns a high ground on this with his expertise on a strange thing called dynamic stochastic general equilibrium theory. And even the former vice chairman, John, migrates away from 2% to some newness. As a formal official, he's a little vague. But where is that in between? Is it 2.7? Is it 3.2? That's the debate.
In the sector outlook over at PIMCO, which the former Fed Vice Chair Rich Clarida led, Lisa, there was a question as to whether they would tolerate 2-point-something. That was the belief with the team at PIMCO, that they would tolerate 2-point-something, because the difficulty getting down to 2 flat is going to be pretty hard. It's going to be pretty tough.
Another way of looking at this is Jay Powell going to come out and say, we don't need to see the pain that I talked about it during the pain speech that was a year ago, where he came out and said, we're going to have to experience a lot of pain to get inflation under control. What if they don't have to jawbone and force unemployment rates up, force people to essentially lose their jobs in order to get some sort of price stability, if they sacrifice what that level of price stability is? And I think that is going to be the philosophical debate everyone's going to be looking at.
If you start to get flaky on 2, Tom, you start to wonder about their commitment to hit 3. That's where the problems come about.
And Furman, you brought up Jason at the beginning, and this is the heart of the matter. It's almost like the terminal rate analysis in equities. Anchored. I think you're going to hear a lot of anchors away at Jackson Hole, which is if you do this and wherever you land, if you become unanchored from the core religion, the core belief, everything changes. I think we're going to go anchors away at Jackson Hole.
That speech on Friday, we're talking about it in 20,000 different ways over the next 5 days or so. That's where Chinese banks keeping a key interest rate that guides mortgages on hold and making a smaller than expected cut to another rate. These surprise moves over the last day or so. In fact, I'd say over the last week, just highlighting the balancing act facing Beijing as it looks to try and boost borrowing while preserving financial stability. TK, things getting harder and harder for the policymaker in China.
Who's the policymaker? Let me know. Give me a brief here when you figure out who the policymaker is. This is monetary theory dovetailed against, I'll call it strategic economic reality within a totalitarian regime. Period. End of discussion. All of the things in our textbooks don't matter here. I think there's been some great work on this in the last week. I mean, really, really strong work. I would lead to Adam Posen, who I believe we're going to speak to at Jackson Hole. And Adam's article in Foreign Affairs magazine is your first read on this train wreck right
Pretty
now.
sure we're kicking off our coverage with Adam on Friday morning.
I didn't know that.
Just to round things out for you this morning, if you're just tuning in, welcome. Former President Donald Trump announcing he'll skip the Republican primary debates starting Wednesday in Milwaukee. Trump pointing to his wide lead in the GOP race, Tom, as justification for the decision after that blowout CBS YouGov poll over the weekend.
You guys are more focused on this than I am. I guess, there'll be some fanfare to it. And what are there, 42 people on stage? It's
a deep field.
I just want to be like England. I just want it to be like a 6-week dash.
Short and fast.
Yeah, I just can't get into this. I'm sorry.
But you will get into it.
Oh, yeah, I don't have a choice.
You will. Wednesday.
It's also news.
Thursday, Friday. Guarantee you talk about it in Jackson Hole. Guarantee.
Well, we're going to be out there, and we're really looking forward to this, folks. A great lineup as well. And off of Lisa last year, and, I think off of what Lisa did last year, canoeing and, all that trouting and reaching in. And, I'm sorry, John, I'm looking up Western River anglers, which is like a fishing. They take a fishing thing out.
Okay.
I'm going to go trout fishing.
You're going fishing this time?
Yeah, with Matt Lloyd and Western River Anglers.
Okay.
And I'm going to go out there and look for sturgeon. It's going to be great.
Cool.
We'll do that.
Looking forward to that.
Joining us right now on China, the definitive conversation of the day, William Lee joins us with all of his work at the International Monetary Fund, chief economist at Milken Institute. Anybody that watches surveillance knows he is beyond prescient. I want you to peel back the curtain, Dr. Lee, right now, particularly on the three cities. What's the level of sweat? What's the level of panic in Beijing?
It is huge, John. And Tom, and when you were asking who's the policymaker in China, when you talk about state capitalism, there's only one policymaker, that's Xi Jinping. And when you have one policymaker who's interested in not only preserving the economy, but also preserving his own position and consolidating power, there's only one set of solutions, which is you got to get the private sector under control. And that, unfortunately, is their Achilles heel, because right now, to restore the Chinese economy, to get youth unemployment down, to get growth going again, you need the private sector. But who in the private sector is going to trust the policies of the CCP?
What is the importance of the dry up of investment from America, investment from the Western world? Within all the great work I've seen, Dr. Lee, the number one thing I'm focused on is we've lost our trust with investment in China. How important is that?
Oh, that is absolutely critical. The discussion at most of the meetings here at Milken among our sponsors, who are some of the biggest investors in the world, they are all asking, how do we do due diligence in China when the information is controlled by the policymaker, Xi Jinping? Private sources of information that they normally relied on to do due diligence, even on the company level, are now restricted. So when you restrict information flow and when you direct common prosperity themes that essentially say to people, you can be successful but not too successful and certainly not too powerful, those are the kind of vulnerabilities and risks that Western investors are now facing. And they're asking the question, do we really need to go to China? Are there other places to go?
Which raises a question. Is Xi Jinping and his party not stimulating the economy as much as people expected because they don't want to or because they can't?
Well, Lisa, as you know, I've come on so many times talking about the fiscal policy tools that they have. The fiscal space they have, the degree to which they can increase fiscal spending depends on a lot of the health of the local governments. And local governments are now so indebted they can't sell more land to finance more infrastructure spending, which has been their main fiscal tool. And so right now, I think they're pretty constrained. And when the renminbi is dropping like a rock, it's very hard for the central bank to be dropping interest rates. And so we have these 5-10 basis point moves that, I mean, this is truly a situation where monetary policy is pushing on a string. When everyone has lost confidence that the private sector can be is survivable, we are asking them to go borrow money at even 5 or 10 basis points. That's not going to make any difference at all.
When I talk with different investors, some of them say maybe this is actually a positive thing for the rest of the economy globally because this will import disinflation to the rest of the world. Do you buy this argument?
I think it's positive for the rest of the economy because Xi Jinping's plan is to make China into a domestic economy and high value-added production. That means low value-added production is moving out to the rest of Asia and other locations. And that's where I think the capital flows are helping the rest of the world. But in terms of the Chinese economy, it's going to be a real hat trick to be able to revive the private sector, redirect innovation in the direction of these high-tech and high value-added industries, and to pull that off successfully right now with such low credibility.
So what is the to-do list for Beijing? Do they use the formulas that have been proven beyond Mao? Do they, as the consensus is, stay with Mao formulas that didn't work? What's their math here on a day-to-day basis? What do you expect to see, Dr. Lee?
They need to make structural policy into countercyclical policy. For example, if they put in a social safety net, that would immediately cut out the need for private sector.
Bill, I'm going to interrupt you there. We've looked for a social safety net since you and I were in our ute. You were back at the IMF running into me in a hallway. There's no social safety net. There's no dominant consumer. It's the same old for Beijing. Do they stay with that script, or can they actually do something?
If they don't change the script, then you're going to have these rising inequalities generate social unrest, and that's the last thing they are able to tolerate. So yes, you and I have talked about social safety. When I was mission chief at Singapore, I suggested social safety net for Singapore, and then 2 years later, they actually put one in. So maybe if we talk about it long enough, and they'll realize that it's either social safety net and allow people to feel safe and they don't need to save as much for themselves, which means they consume more, or you get social unrest. And if those are the trade-offs, I think Xi Jinping will go towards safety nets.
And this is why that youth unemployment number is just so important at the moment. Bill, thank you, sir. Bill Lee there of the Milken Institute. If we played the game at the start of the year, what would be up more? The Hang Seng or the S&P 500? How many people would have said Hang Seng down 11% year to date, S&P 500 up 14%? Tom, 25 points of outperformance on the S&P 500.
Yeah, that's the way to look at it.
What happened to China
the differential
reopening?
Well, the China reopening has failed. And again, this is where the currency comes in. On radio, we're showing it right now on TV, 7.31 yuan per dollar. No one thought we would get to that. And I'm going to use this word carefully, devaluation. This is not a free float, in my opinion. And Dr. Rogoff can tell me I'm wrong. But the answer is this is a devaluation of the currency. And the number one sweat or panic I see is that's log convex right now. And that accelerates out 7.40. I'll let an adult tell me. But the answer is that's a single statistic to watch.
The twin surprise of 2023 so far.
Yeah.
The underperformance, the downside surprise we've seen from China, and the outperformance, the upside surprises we've seen from the United States going into Jackson Hole later this week.
And
to take it even further to Nvidia later this week, it's the 7, 8, 10 stocks here, the technological superiority of the U.S. right now versus what you see in China.
Average price target on the S&P coming into the new year was just north of 4,000. Hey, look, their year-end price targets, we've still got some work to do this year, but that was the year-end price target at the start of the year, just a little north of 4K. And then on watch for record highs at one point in July. Do you remember a couple of weeks ago, it was all soft landing hopes and dreams, and then a bond market sell-off later, and it's all hard landings, Fed's got to do more. It's amazing what price can do. Yields right now higher in the bond market, much more on fixed income in the next hour. Amanda Lineup of BlackRock, 7:30 Eastern Time. That conversation about 50 minutes away. Equities positive here by 0.4%. Yields are up, treasuries are down from New York. Good morning.
if you continue to see that movement higher in yields, then of course you have to look at tech stocks that traded up to their 2021 peak just a couple of weeks ago. And that's why they're underperforming. They're underperforming not because they all of a sudden became worse companies. They're underperforming because they went up a lot, got very expensive, and now in that context of higher yields, you can't really justify that expensiveness.
That was Cameron Dawson, a new edge going into the weekend after a bond market sell-off has dominated the airwaves for global financial media. Continues this morning too. Let's talk about that. Equities right now positive on the S&P 500 by around about 0.5%. The move continues in the bond market, or should I say resumes. Yields are higher by 4 basis points on a 10-year, 4.30 on a 10-year in America. Think about the levels last October. 4.30-ish was the high for the cycle. We're at those levels again in the bond market. So 10-year on a closing basis, the highest levels we've seen since 2007. We're talking about decade highs at the long end on a 30-year right now. Yields up to 4.43. This was the stuff of dreams in the depths of the pandemic when all you could pick up was something like 60-ish basis points on a 30-year, Tom. And now you can get 4.30. Do you want some of that?
Yeah, but the way I'm going to look at it, John, is I'm going to go from the nominal yield, which I totally agree is what we're living in, but I'm going to go to the investable real yield, and all of a sudden there's some substantial real yields where you go, wait, how does this work? For example, pick a number, 7% mortgage rate, whatever your belief is the inflation rate is. Let's say it's 5%. That's a 2% hole every year. You've got to pay out a 7% mortgage within a 5% inflation. I mean, the math doesn't work.
March 9th, ugly times, 0.6987% was the low in the pandemic on a 30-year yield. Lisa, south of 70 basis points. Nobody that came on with us at that point was looking out 2-3 years and suggesting we'd be anywhere near where we are right now.
And maybe it's just the people who I speak to, but the people who did suggest that rates could go substantially higher were calling for, some sort of financial meltdown in response because everything had been hinged off this ultra low rate. So this would cause absolute havoc across the financial system. And here we are, stocks grinding higher and higher, and people basically looking at that soft landing and gaming out that the Fed's going to win this.
Is the Fed going to win this? Is that what they're gaming out based on this?
Actually, what we're seeing, no, they're not going to win the war on inflation, but they will win the war on achieving some sort of stabilization to a new high that doesn't destroy the rest of the economy and lets everything else chug along without the unemployment rate rising. There was a recent poll done by NBER that basically confirmed that now 70% of respondents thought that the Fed would achieve a soft landing. 70%. That's turning on its head what it thought just a year ago.
Hopes and dreams, Tom. Hopes and dreams.
The hopes and dreams of Jackson Hole are to August 31 PCE number and September 13th CPI number. Maybe that will be in his speech. We just got to wait to see what those two dates are.
Yeah, which is why dancing around what they will and won't do in late September when you've got more information still to come. How much value is there in that?
No, I think like Mohammed Al-Arian, is he on with us today? I don't even know what the schedule is.
Should be with us later this week.
The intern's left, so I'm lost. What can I say? But the answer is Dr. Al-Arian is going to be with us later this week, and his essay in the FT is important. And what's not in there is data dependency. That's the excuse Chairman Powell has.
We are data dependent.
Yeah, we're also intern dependent. Look where that got us. Right now, joining us, and we're going to get a brief here on 57 things in tech. But what I really want to do is once and for all dive into what this thing, Nvidia, is. Mandeep Singh is going to make your morning, senior tech analyst for Bloomberg Intelligence. We really haven't done this exercise. Nvidia RTX trademark and Nvidia Omniverse trademark deliver the performance to help professionals, creators, developers, and students worldwide enhance creative workflows and build, operate, and connect metaverse applications. Butch Cassidy and the Sundance Kid. Who are these guys? Who is Nvidia?
Well, they have a history of almost 25 years in the graphics domain where they made the chips that enabled all the games, and gradually they branched out into first crypto and now generative AI. And what they've been really good at is catching the new trend early on. This space isn't new. AMD has been around, Intel has been around, but what Nvidia has shown time and again is they can catch a new trend early on, and they can actually have performing chips in that space, and that's what they've done with generative AI.
When they report here this week, are they going to sustain the financial analysis screen I see on the Bloomberg? They're popping 70% gross margin to bringing down 40% net income margin. Come on, this is like a cartel.
It is. And even before generative AI, they had those kind of operating margins. And what's really unique about NVIDIA is they've got the pricing power. No one else in this space has been able to show that kind of pricing power that NVIDIA has shown. So that just goes to show they've got some real IP when it comes to training these large language models, which is why, hyperscalers, even though they are developing their own chips, they're willing to pay NVIDIA the dollars when it comes to getting the inventory for their chips.
Which is the reason why people are trained on Wednesday and the fact that NVIDIA is going to report earnings. And perhaps more interesting to me is less the earnings and more the market's response. Does the market need to see the dollars coming in the door to justify the hopes and dreams that have been baked into the share valuation?
Absolutely. I mean, last quarter, they raised their guidance by almost $4 billion. For this quarter. So when you blow out the numbers like this, expectations do go high, and the stock is obviously trading at, 25 times sales. So you have to ask yourself, even if they raise guidance this time around, can they raise it by 40, 50% the way they did it last time? And if they don't do it, that's when you could see a negative reaction.
There's a question also around whether the halo of this godliness of AI, which seems to have permeated through the entire tech sphere in the U.S. equity markets, whether that's going to sort of percolate out to the ARM IPO. I woke up this morning, I was reading about it, and I was reading about it last week, and I didn't totally understand whether it was just sort of this offshoot, not important. On a broader scale, though, it really signifies how much demand there is for the hopes and dreams of AI. What are you looking for as we get a greater sense that could really bleed into the sentiment around NVIDIA?
I mean, look, when it comes to generative AI, we know workloads were moving to public cloud before. Now everyone is saying, what is my non-discretionary spend when it comes to building the data centers? It used to be cloud. Now I think it's more and more AI. Every board discussion is about, do we have exposure to generative AI? And even though the ROI isn't established yet, but every company right now wants to invest in AI, and it will remain the case for the next 12 months.
I did sophisticated research on this. I went to the NVIDIA website. I clicked on the word cloud. I'm going deep into this, man, deep right now. Unleash the power of accelerated computing in the cloud. Is NVIDIA Microsoft's friend or foe? Are they Alphabet's friend or foe? Are they Elon Musk's friend or foe?
So the answer will differ. I think when it comes to Microsoft, Microsoft right now wants to be friends with everyone. That has been the approach that has worked really well for them over the last 5 years. I think when it comes to Amazon and Google, they have their own chip strategy. They want to sell more of their own chips when it comes to especially generative AI. And so it will vary. Tesla, I would say, Tesla has their own GPUs. They started off with Nvidia. Then they gradually pivoted to their own chips inside the car. So clearly, hyperscalers are a threat to Nvidia. But what Nvidia has done well is they are always ahead.
What in God's name is a hyperscaler?
Well, hyperscalers are companies that have got huge data center footprint, and they are renting that data center capacity to all the small and mid-sized and even large businesses whose core competency is not to, deploy their own data centers.
Mandeep, I remember a company called Arm Holdings, used to be listed in London, wonderful management team led by Simon Segars. Is that coming back to market now then? And at what price? Yes, we are expecting their F1 to be filed today, and then they'll do a roadshow. And from what we have learned, they will probably price the IPO at $70 billion. They're looking to have like 10% float here. And look, the revenue, trailing 12-month revenue was around 2.5 to 3 billion. So clearly the valuation is rich in this case for a new IPO, and we haven't tested the IPO market lately. And it'll be interesting What
to
did
say.
SoftBank pay for that back in the day?
They paid $32 billion. And remember, Nvidia tried to buy that company at $40 billion. That deal got terminated because of antitrust concerns. So that's your floor. But $70 billion is still a stretch.
I think so many of us forgot the history of all of this over the last several years. Mandeep, it's good to see you. Mandeep Singh there of Bloomberg Intelligence going into Nvidia earnings. When are they? Wednesday. Nvidia earnings coming up on Wednesday. Gillian Emmanuel's going to catch up with us on that. Two big events for this equity market. Chairman Powell on Friday. And then, of course, the earnings from Nvidia, Tom, on Wednesday after a gain of close to 200%. Yes, close to 200% year to date on that stock.
It's got to be important just because of that, but also after what we've seen from the others in the drawdown, if you will, in Microsoft and Apple, it's going to be a reaffirmation of how tech is doing getting out to the end of the next quarter.
Bit of a bounce this morning on the S&P 500, up by 0.4%. The band is back together. TK's back in a hot seat. It's always a good thing, Tom.
It's good. You know, Bayern was great. I thought Bremen was beautiful.
You've been watching the football?
No, I went. Bremen was
right.
great.
This entire economic cycle has felt like it's been on fast forward.
All this talk about a recession so far hasn't panned out.
This current correction is not about growth fears.
What I see is a pull forward of consumption.
We are expecting that both Fed and ECB will stay on hold next month.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Getting deeper into summer, rounding things out. TK can't wait for Labor Day. That's why he's back in the seat. Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance. What's that about, TK? Wishing away summer in America.
Ugly
What's that
Americans.
all about? What's that
guys,
about? Just sort of wishing it away.
Here's the difference, okay? You guys are always on holiday. People that live on the continent, like Francine Lacroix, what they're doing, and Maria Tadeo, they're planning their next holiday where they're on holiday. All we do in America is work.
Let me speak for you guys. If we had the weather that you guys had here, which is phenomenal, then I would stretch summer right the way through September.
What is this, you guys?
Deep
What is
into
this generalization?
October. This is just a bit of banter, Bremo.
I like vacation. I grew up in America.
I think we're both on the same page here.
Sorry,
we
carry
both
on.
like vacation. It's TK that doesn't seem to like vacation, but it's good to have Tom back with us. Your equity market on the S&P shaping up as follows. Equity futures right now positive by 0.4%. Yields are a little bit higher, but that's been the theme, Tom, on a 10-year. Back to 430 over the last week.
That's a huge debate. We're going to have Julian Emanuel with us dovetailing in with Ed Hyman's economics here in a moment. And it's just a raging debate. Now what? That we're back at these levels. And what's important here is the breakthrough price. For example, I looked at Lisa's Bloomberg Total Return Bond Fund. And if you take the trend from 2007 Jackson Hole out to 2021 Jackson Hole, we are 5 standard deviations down in price. I don't think people realize how off trend we are when we go out and visit Friday, and that's in the market here on a Monday morning.
It sets up the tension for Friday, Tom. This tug of war right now, some real tension between the progress we've made on inflation and the fact that growth is still running above trend, and the risk that this Fed declares victory too early and inflation starts to accelerate again, and that's what they want to avoid. Big time. Going into year end and into next year.
I totally take that point, and I've taken it for years. It's not just the Japanese, I'm going to call it 15, 20 years ago. It's other times in central bank history where you go, we're going to raise rates and then, or lower rates, whatever, and you go, oops, we made the wrong decision. That sits in the mind of everyone reading those papers.
We've already had one big oops, Elisa, from Chairman Powell in the last couple of years. He doesn't want another one.
No, and that's the question. Is he going to really look back at transitory and say, okay, mea culpa, we got this one wrong, and we are entering a new normal with some structural shifts that are happening right now? Unclear that he really wants to do that. Let the data come in to get some breathing space. Mohammed Ali is talking about, okay, just talk about some esoteric economic point that matters to no one and really come out with some conviction on it. And then, you know, you've said something, you've done your job, check that box, and you've done nothing to really harm anything or really change anything on the Fed.
Let's just be clear on this. Mike McKee, I don't know where Mike is. He's like, I don't know.
He's in the building, I think.
He's in the building?
I saw him walk in.
The papers at Jackson Hole are really important. And at 7:03 a.m. on Monday, John, we don't know what they are. They keep them hermetically sealed. And the answer is, who wrote the papers? Usually it's young bucks coming up the food chain. And of the papers, everybody will have their favorite paper. I agree with you in the last hour that what I'm really going to focus on is R-Starred study. The whole R-Starred debate is the paper I want to read about. Maybe I'll be wrong. Maybe there'll be something else.
That neutral rate, which we'll discuss through the week. Quick snapshot of the market for you. As I said, equities are higher this morning. Treasuries lower again. Yields advancing by 4 basis points. Lisa, just short of 430 here at 429.62.
The week begins possibly tomorrow, where we get the BRICS group meeting over in South Africa in Johannesburg. That's Brazil, Russia, India, China, and South Africa. Key question will be how much China brings India in particular to their side when it comes to creating some sort of economic and strategic rival to the G7. Wednesday, Nvidia earnings after the bell. Republican primary debate in Milwaukee also taking place. Key question around whether anyone will be watching or whether they'll be watching some counter-programming done on a platform yet to be named. And on Friday, all eyes are on Jackson Hole and what we hear from Fed Chair Jay Powell. He will be speaking at 10 a.m. Eastern. We'll also hear from Christine Lagarde. Is there going to be some sort of cohesion on what the new normal globally is, or are you going to start to hear a difference between these two policymakers in terms of their hawkishness or not as they head into a very different fall?
But my history here, help me here. I don't think they're going to talk monetary theory in their speeches. They're going to go wide. I mean, the sort of the courtesy of Jackson Hole is not to talk about what are we going to do at the September meeting.
That's your sense of things.
Yeah.
I'd say the one thing they're on the same page about is they've got no idea what they do beyond next month.
Exactly. They're data dependent as anyone. And Lagarde has to deal with Germany flat on her back and a few other items as well.
Great guest in the studio with us, Julian Emmanuel of Evercore. Julian, good to see you. Good morning, mate.
Good morning.
Let's start here. This week, Nvidia. Then we've got Chairman Powell. Throw in China into the mix as well. If you're coming back from the beach, dazed and confused, and you had to pick one right now, what should you be focused on?
Sorry, there is no pick one here. All of them matter. And to us, that is a large part of why we've seen the market drift gently lower, people taking risk off. This is not an end of bull market run. This is just a correction. Normal, seasonal, again. I would say what's really important is less what we're going to hear from Nvidia, less what we're going to hear from Chair Powell, less what we hear. And overnight, we obviously had some moves from China, and more the price action in response to all of these things. And frankly, it's an open question as to what we're going to see in terms of the price action.
What everybody wants to know is to dovetail Julian Emmanuel's equity work in with Ed Hyman's economics. Ed has been out front believing in the disinflationary trend. Does he still have that in place, and how do you dovetail that into an equity call?
Absolutely. Absolutely. Ed, continues to think that inflation is going to come down much more rapidly than people believe. And, of course, part of that is we're likely to have a very mild downturn early next year. But when you pull back and you think about the implications for investing, there are actually 3 lessons from the 90s that we need to learn here. Number one, we understand the run-up into technology with AI, et cetera, et cetera. We think that's real. But the other thing there is that there is a time, such as we saw in the 90s, where markets do pull back. But the more important thing, because we've been talking about yields already this morning, is that you were able to make money in stocks in the 90s when yields were 5 and 6%. And the same thing is going to happen in the next 24 months.
Yeah, and that's what we were talking about with Ed Yardeni last week, which is we've seen this movie before and it's fine. When we talk about China, is there any silver lining in the disinflation that we see over there, kind of creating more disinflation in the U.S., in Europe, or do you not buy that, what some people are putting out there?
Well, Chair Powell would love to be able to think that. I don't think he's going to discuss that on Friday. It's very marginal. If you look back at the episodes where China weakened incrementally, they had a volatility-inducing effect in the U.S., very temporary. As we know, the U.S. is very much its own engine.
We've seen some divergence. Do you sense that divergence can continue between what's developing here in the United States and what's developing in China?
So that there is a point to which it cannot, okay, which is why, again, what's so important is exactly, are we going to have a whatever it takes moment in China? Or conversely, if we have what the market perceives to be a whatever it takes moment, is it going to be that famed Greenspan phrase, pushing on a string? It's an open question.
I look at the equity market. I want to go back to what Lisa brought up, the brilliant interview they did with Yardeni last week, and what Ed feels and what we all lived in 94. 94 had almost a malaise in it. And then, boom, 95 moonshot. Can you call here a second leg of a bull market at some point out there, given the emotion, the malaise we're in right now?
We think it lies ahead. we think you have to go through, and again, this is another lesson of the 90s, right, is that the technological revolution that we think we're undergoing right now with generative AI, it didn't negate the idea of a recession. It postponed it, and I think that's part of the narrative. We are going to have a recession at some point. Business cycles are not canceled from things like this.
So where are you looking to really see the ramifications of a new higher rate world? You were talking about how we've seen 5% yields before and stocks keep rallying, but some areas fell out of bed. Are you looking for there to be similar carnage in small pockets that cannot survive at rates that are as high as they are after growing up during an era of zero rates?
Well, profitless tech that's going to have to refinance over the next several years will certainly be under stress. But think about it, in an environment where rates are high, inflation is still high, and economic growth. I mean, GDP now is pushing 6% this quarter. That's an unfathomable number. That's where value, largely forgotten, energy and healthcare looks interesting to us. And if you're a hedger, the fact that interest rates are over 5% is very, very good math for option hedging strategies.
Ed Hyman has no clients who are under 70 years old. We all know that. But for the Ute of Evercore ISI like yourself, how do you and Hyman and the rest, how do you explain to people that have never enjoyed high interest rates, a legitimate a real yield, a legitimate risk-free rate? How do you explain to them that we didn't all die and roll over in the 90s?
So what's fascinating about it is, if you remember, for much of the post-financial crisis world, there was an angst every time the market started rallying, and there was a feeling like it was going to run away. Why? Because you couldn't make anything on your cash. Okay? This time, people are like, okay, I'm good. I'm still getting 5% on my cash, which actually, if you think about it, is the thing that feeds the longevity, multi-year longevity of a bull market.
The demo goes beyond the 70-plus demo, doesn't it? For research over at Evercore. Julian, what's he talking about? What's he talking about?
I'll tell you what, given the work that we've done on generative AI, to have the 20s and the 30s people and interact, we've got it all covered.
You tell him, Julian. I want to understand this, Tom, why banks are down so hard with yields up and the curve steeper over the last month.
Well said.
If it's good stuff, yields are up 33 basis points in August. You want the banks on the S&P 500, they're down 8%.
You know what I'm looking at?
Through August.
Well, I read Crane's every day, and you have a great website, Real Estate with Bloomberg, and I'm sorry, I'm watching what the adults are doing, and that's Vornado. And the answers, you talk about the banks, these seasoned CRE people are acting. They're not in, there's no task forces. It's like, what do we need to do this week to unload property X or buy property Y or get the Japanese to buy a building in Lower Midtown? Whatever. That's what I'm watching.
Given the way things are going, they can't afford a task force right now, Tom. If you're just tuning in, welcome to the program. S&P 500 futures here positive by 0.4%. Yields are higher by 4 basis points on a 10-year, 429. Julian, just quickly, what's that about? The move we've seen in yields and the bank's not rallying, the bank's actually selling off.
I think there's still this thought, again, and that's Ed in our base case, that you're going to have a recession out there somewhere in 2024. And look, as much as we want to think the Fed completely backstopped the banking system in March, there's still the potential
Those worries
for
still linger.
Financial volatility.
You get the sense of that, Tom? Those worries still linger from spring? Haven't quite cleared the decks and moved on?
I'm in that camp. I am in that camp because of CRE. Everybody's telling me it's just office buildings. Everything else is fine. I'm watching the action of these people. And again, there's no task force. They're like, let's go.
There's also an issue with the fact that people don't want loans, right? They're not necessarily taking out loans, so they can't capture those higher yields because no one wants to pay them, number one. Deals aren't getting done, number two, because yields are too high. You're seeing a lot of that sort of investment banking activity fall off. These are major sources of revenue that have stagnated. Talk about the mortgage market and all those mortgage brokers. You know, think a thought for them who are not really doing so hot this year.
And off of ARM in London, which I really don't understand. But John, over the weekend, there's this percolation. IPOs, they're going to come back. Says who? I mean, ARM, whatever, AIM, ARM. ARM, yeah, whatever. Software. SoftBank.
7:30 Eastern Time. 15 minutes away, 16, 17 minutes away. Amanda Lynham of BlackRock. We'll have a conversation about fixed income and credit and the refinancing that never was, the maturity wall on the horizon, and how painful it might be. All of that good stuff on a Monday morning. Live from New York City. Equities are up. This is Bloomberg.
Do you think that Donald Trump should drop out of the race?
I think so, but obviously that's up to him. I mean, you're just asking my opinion, but he will lose to Joe Biden if you look at the current polls. I'm a Republican. I think any Republican on that stage in Milwaukee will do a better job than Joe Biden, and so I want one of them to win.
That was a word from Senator Bill Cassidy of Louisiana speaking on CNN over the weekend. Live from New York City this morning as we kick off a brand new trading week. Your equity market with a little bit of a lift. 4 days and no gains on the S&P 500 coming into Monday this morning, up by 0.4%. Yields are higher by 4 basis points on a 10-year, 429.42. Just publishing moments ago, Max Kettner of HSBC. We'd used renewed sell-offs in equities to scale up exposure even further. The take from buy? Max Kettner, I believe that means buy.
Scale up exposure.
When you get paid lots of money, Tom, you have to find new ways to send buy. Okay? You know how this works.
Okay, so if you're going down Madison Avenue and you walk in any given luxury store, you scale up exposure?
Maybe. Maybe that's if you paid lots, Tom. If you paid lots. Looking elsewhere, TK, looking ahead to Chairman Powell, of course, on Friday. Nvidia earnings coming up on Wednesday. Lots of worries, no doubt, about China. Somewhere in between.
Senator Cassidy there, Louisiana, he's in our Hall of Fame. He's a doctor. He's like the real deal.
Didn't he tell you to lose some weight?
So we're sitting here, and he's sitting here right now.
I was here.
Like, man. We're live on here. He goes, lose some weight.
Lose some weight. Did he know the microphone was hot?
No, you know, it's like, you know.
He speaks his mind.
Yeah, he speaks
I think
his
we
mind.
heard him speak his mind about the former president just then as well.
There's a lot of that going on here. We've reviewed this morning the CBS poll by Donald Trump. John, I want you to bring in Emery Horton because you guys are way up to speed on this versus me. But this is not another poll. This is Anthony Salvanto over there with Margaret Brennan and Face the Nation. And the depth of that poll is extraordinary.
MH, let's start from the top, and good to catch up with you this morning, as always. Walk us through just how dominant that lead now is for the former president.
Well, it's the widest lead we've seen yet in any of these polls when it comes to the former president and his hold on the Republican Party. This obviously comes ahead of a really crucial week for the GOP and the candidates as they face off in Milwaukee for a debate, although the former president does not plan to attend. He'll do his own sort of counter-programming, although we should note his VP, Mike Pence, former VP, said over the weekend on ABC that he knows the former president very well, and you just don't quite know until the very end. So there is this little bit of potential that he would show up. But at the moment, it doesn't look like he'll be showing up on that stage. And if you're the former president, you have to think, why should I? I am dominating in these polls. And his lead even widens so much against the second candidate, and that is Governor DeSantis, who's now at 16%. So his numbers are falling, and then everyone else is in single digits. So you have this hold on him. But I would also bring you another poll this morning from NBC News and the Des Moines Register. And what that is showing is that there still is a little bit of wiggle room for others to potentially shine. It is still early on in this race. But of course, the former president is an incumbent, so it's different than any other candidate we've ever seen.
There was a lot of fanfare around Tim Scott over the weekend as people try to game out who number 2 will be, with Ron DeSantis pretty much losing a lot of his sheen, a lot of questions around his campaign. Is the energy really coalescing around Tim Scott? Is there discussion about new entrants into the race? What's kind of the feeling in D.C.?
So two things. When you look at Tim Scott, and I would again point to this NBC poll out this morning, when you see the favorability of this individual versus disfavorability, he has really good numbers. He has very high numbers on favorability and low numbers on individuals who don't think favorably of him. So he has this potential, and people want to hear more about him, but in the first glance, they seem to like him. I would go more so about what's being spoken about are the individuals that are currently not in the race. And I'm going to give you two governors, Governor Youngkin of Virginia and Governor Brian Kemp of Georgia. Both of these individuals closed out on Saturday this conservative gathering in Atlanta, and the conservative talk radio host who was talking about it said, I was going to make a joke that this is the Republican ticket, but I'm not. They're not running. But the fact of the matter is, Brian Kemp is becoming somewhat of a kingmaker, and this is someone who has stood up against the former president when it comes to Georgia's integrity and the election. And then obviously Glenn Youngkin, a lot of donors, a lot of Republicans are in his ear. They want him to get into the race, and the most important one, Rupert Murdoch, according to Washington Post reporting last week.
And Lisa, Anne-Marie, one final poll that's just out. This poll is just in, and it states that the Yankees are in last place. I noticed 1-9 with the Red Sox sweep as well. We need to bring that poll to you right now. Folks, let's move over to the other side. What's the Biden plan? I get it, he's incumbent. He's doing Camp David summits. Wonderful. What's the plan?
Well, Biden today will be visiting Hawaii and seeing the devastation of these wildfires. It comes at a critical moment for him. This is one of his biggest domestic policy issues, or I should say controversies, because he was silent for a number of days publicly. And when he was asked about it when he was vacationing in Delaware on the beach, he said no comment. And many people view Biden, right and the left, as this compassionate leader, even if they don't agree with his policies. So he has a moment today to potentially bring that warmth and empathy to a place that's the images and the death toll, especially amongst children, is horrific. But he will be in the spotlight in terms of the fact that there was this controversy because he remained silent for what many would say was too long.
Right. Does he have a plan in Ohio? Does he have a plan in Arizona or Georgia to get the turnout that got him elected if Mr. Trump had more votes last time than the time before?
Well, this is a great question because what you've seen in past presidential races like Obama this second time around is that you do start to see independents and their votes dwindle in some of the major cities in these swing states. What the Biden administration is doing right now, which feels like campaign events, is that they're going around the country in some of these states. He was just in Wisconsin. He just sent his Treasury Secretary to Nevada. They have been in Arizona. And they are talking about the wins they've had under his last 2 years. And they are trying to sell that those wins are going to be good for the economy because it still is top issue for American voters. It's pocketbook issues like the economy, like inflation, that they want to hear candidates talk about. So that seems to be their plan so far. Obviously, this will all ramp up next year.
We talk about the key issue of the economy. Both sides have the same kind of general issue that they're concerned about. But when you dig into the granularity, it's completely polar opposites in terms of the perception of the economy. What is the economic issue that there is any cohesion on both sides? Just simply bringing inflation lower? Is there any cohesion around the Fed? Is there something that really kind of is a driving force in the election?
Well, on one side, on the Democratic side, you really just have Biden, right? He is going to be the nominee, and he is the current president. On the Republican side, there is some divisions. They're all going to bash the Biden administration, and they have been, when they talk about the economy, and their number one issue has been inflation. And they even say to the Biden administration, yes, inflation is coming down. It's slowing at a slower pace, but still, Americans are paying much more for groceries, for food, for rent than they were before Biden came in. So that is their argument. When it comes to the Fed, we've seen very different views. There are some individuals, like the former president, who want to get rid of Jay Powell if he was elected. Also, VP Mike Pence. There's others who just don't want to pinpoint specific appointments and policy decisions just yet. And then you have others like Governor Chris Christie, who said he didn't think Jay Powell, yes, he was late, but didn't think he's done anything horribly wrong. So these issues are going to be front and center on Wednesday, especially if the former president is not there. It is a potential for all these candidates to talk about their main policy objectives.
It's the cheat guide on the economy, Tom, going into Wednesday. Bidenomics bad, Chairman Powell, no thank you, and bash China. They seem to be the 3 points.
I think that's good.
Into Wednesday.
Yeah, I totally agree. And maybe bash China, you put that first because it's a bipartisan effort. You can get people right up. To me, and this is getting way out front, way over my skis here, it's about turnout. And I can't say it enough.
Isn't it always?
It's always about turnout. And you got to talk about turnout in November next year now.
That's the cheat guide to political punditry, isn't it?
Yeah, it is.
It's about turnout. AMH, thank you.
I'm looking
down
at
in Washington, D.C.
Data dependent.
I'm not concentrating. I'm looking
That
at
too.
Zandvoort. Do you know there's Formula One racing this weekend?
Didn't know that. Is it back?
Yes.
Very cool.
Back.
Very cool. Four days, no gains on the S&P 500. Looking to change that this Monday morning. Good morning to you all. The price action shaping up as follows. Up 0.5% on the S&P. On the Nasdaq, up by 0.6%. The tail of the month, brutal. The Nasdaq 100 down on the month by close to 7% so far this month. If we closed here, Tom, shut it all down for the month of August, worst month of the year.
Worst month of the year. It's a pullback. I mean, there was a lot of good work this weekend on correction. Not bear market. A correction is 10%. I do it by standard deviation, which is some fancy math nobody cares about. And the answer is we're supposed to do this. This is normal. You don't go up every week with your Apple or whatever.
But you know what happens every time it does happen? Is it something more sinister? Is it worse? Could it go further?
Is it a toxic brew?
Is it the end of it all?
It could be a toxic brew.
Could this move in the bond market continue? Let's turn to treasuries, 2-year, 10-year, 30-year, 10-year. The yield climbing for 4 consecutive months. Over this month alone, we're higher by about 30 basis points this morning. Up another 4, Tom. Let's call it 430 for those of you that like it a little bit more specific. 429.82.
So if you have
on
a
10-year
chart
this morning,
and you have a curve to the chart, and you take the y-axis and you go logarithmic, that's all I'm going to say about the math. If it's still curvy after you've gone logarithmic, that's called log convex. Everything, including renminbi, the 10-year real U.S. real yield, the German paper, everything right now is log convex.
yields up and away, Lisa, on a 10-year,
all the
on a
math we're
30-year
doing
as
on
well,
Monday.
this morning as well.
It's significant because we're reaching levels that we haven't seen in almost 2 decades. It's also significant we haven't seen a bigger pullback in equities, in credit. To Tom's point, that's notable. We normally would have gotten some sort of big retracement. Suddenly the market is interest rate sensitive. Not anymore. And so now people, like what we heard from Julian Emanuel, gaming out. Okay, what if they stay here? So what? We've done this before. Welcome to normal.
Credit hasn't done much at all. We'll talk about maybe some refinancing activity later into next year, changing some of these prices. We'll talk about that in a moment. Let's finish on foreign exchange. In the FX market, the euro just in and around 109 through much of this morning. 109.11 right now, positive by 1/3%. The euro showing a bit of strength. Under surveillance this morning, the bond bulls doubling down in the face of subpar returns and a deepening sell-off. Bob Michael of JP Morgan Asset Management, among the bulls that are still bullish on this bond market, saying his strategy is to now buy every dip in bond prices. And Tom, there's been plenty of dips in bond prices over the last couple of weeks.
I mentioned it earlier. I just taken all the summed in. This is the Lehman Index, the Barclays Index, now the Bloomberg Index. There's 5 or 6 of them, and the answer is I just look at the total return, the bond market all in, and boy, has it been price down, yield up, and we're way off the trend, that comfort trend that Bill Gross talked about for years. 5 big standard deviation move.
I think it was Gagi over at BlackRock that said yields of dreams. Yields of dreams. Tom, 2 years ago, these were the yields of dreams.
If you clip
They're here now.
they will come.
Something like that. That's good. That's good, Tom.
Are you
That
okay
works.
there?
That was actually brilliant.
Look, I'm medicated. What can I say?
If you'd said this 2 years ago,
where's the tang?
That we'd be here, TK, no one would have believed you.
No one.
No one would have believed you.
This goes into Jackson Hole. Okay, let's dovetail Bill
And now
Gross,
they're here,
Muhammad
and people
Alarian.
are sitting here saying, "Oh yeah,
This is
don't like this."
This is the great moderation that built BlackRock, and it was a stability, and it was forever yield lower, price up. Wind, behind you. It's a sailboat analogy, I think. You should see me on a sailboat.
This is going well, Tom.
This is going well. But the answer here is the great moderation is over. And that's the backdrop for Jackson Hole.
You've had a lot of time to think, haven't you, in the last week?
Way too
You
much
can tell.
time.
Chinese equities. Let's
Can you
talk
go
about
back to
those.
work? Go back to
Extending
work.
losses. The Hang Seng seeing its longest losing streak since 2021. The Hang Seng in a bear market. Mainland banks surprising by keeping a key interest rate tied to mortgages on hold. Lisa, where is that stimulus that so many people are waiting for?
They keep underwhelming, even though they see the reaction as being negative in risk assets, raising the question, unwilling or unable. is that really the question for a lot of the Chinese policymakers at a time where we heard Bill Lee say they're pushing on a string? We're looking at a situation where they can't stimulate without causing pain to the financial system and just further the contagion.
Who we miss right now is Elizabeth Economy, her iconic book, The River Runs Black. She can't talk because she's working for Gina Raimondo at the Department of Commerce. But Dr. Economy and others, and again, I go to the Adam Posen article, Ian Johnson also in the new edition of Foreign Affairs, definitive reading on the complexities that the dictatorship in Beijing faces.
At least warned about some of these issues for a
Huge,
long
way
time.
out front, way out
That's
front.
a voice that's missed.
Yeah, it's missed, big time.
Great she's in the administration, Tom, to your point. I wanted to finish on this because we have a great guest around the table, but this is important. California, of course, bracing for flooding from Tropical Storm Hillary. The National Hurricane Center warning of, quote, life-threatening and catastrophic flooding. The storm also amounting to over 550 flights cancelled just today and tons more over the weekend. Tom, we're talking about a year's worth of rain in parts of California. Just unreal figures.
Not Florida, but not funny as well. And it does go into the aberrations of the moment. I would note, I don't have it in front of me, but 3 tropical storms building in the Atlantic, which is highly unusual. There's only been 2 times since since Bogart was in that place in Florida with Lauren Bacall. But the answer is it's an unusual season to begin with, and how unusual this rain on a desert parched floor is.
Well said. And Tom, just to wrap it up, yeah, absolutely. I think our thoughts with everyone on the West Coast this morning, TK. We hope they all stay safe.
I talked to the middle child is out there, and she's on strike lines. And, it's...
Oh, she's striking?
She's striking, yeah. She's out picking and I don't know what for.
She's learning your communist ways early.
She's got a degree. She's got a degree. Yeah, exactly. She never watches. It's too early in the morning for her. Always watching is Amanda Lynham, who was brilliant the last time she was on. She's had a macro credit research. This is without question our fixed income interview of the day. Amanda, thank you so much. I want to go to the nitty-gritty of what you do. You have debt that is fixed coupon, dynamics, floating, like John's really familiar with in Europe and England, which is where the yield floats around given the movement. And then you've got CRE, commercial real estate, and all the debacle there. How unstable or potentially unstable is a fixed income world right now?
Good morning. Thank you all for having me. I think they're all impacted by this higher cost of capital environment that we're expecting. And Lisa, you alluded at the start of the program, is this the new normal? And I think the key difference between what you highlighted, Tom, is that for the fixed income, fixed rate part of the market, they're getting impacted on a different timeline than the floating rate part of the market. And in that floating rate part of the market, specifically the broadly syndicated leveraged loan market, you are seeing an uptick in defaults. And this is something that's been happening for the past few months, but the magnitude of the pace of leveraged loan defaults outpacing the fixed rate high yield bond space has been notable. It's the widest margin since the Moody's data began in 1996. We see scope for that to continue, even though it is unusual, and that's because we are expecting this higher for longer cost of capital environment. The other 2 things I would point to is that the fixed rate investment grade universe is much better positioned to manage through that higher cost of capital environment because they just have more optionality in terms of refinancing. So we don't always rely on ratings as a barometer for performance, but I think in this instance, being investment grade, having the ability to replace maturities at a later date instead of refinance them is going to be helpful. And then on the point on CRE, Tom, I think really nothing in the news flow over the past few weeks has changed our view that we're in the early stages of the distress cycle in CRE. And I think, in fact, the news flow recently has reinforced that view. And it's a combination of refinancing,
that
but
was
also
uplifting.
structural issues.
Save us, John.
High yield spread still super tight into the tights of the year.
Yep.
And this is happening even with a higher for longer conversation around the Federal Reserve. You know where that maturity wall is. So walk us through it. Why are spreads this tight when we face the risk of that maturity wall kicking in later next year?
Right. So 2 things. One, as it relates to the timing of the refinancing. The maturity wall we know begins in 2025. High yield corporates will want to address that 12 months or more beforehand so that the debt doesn't become current. That has implications for the audit. So we still have some time. And as we've noted, high yield corporates in particular have have the luxury of being patient because they've been so proactive about liquidity raising in 2020 and 2021. And it was not unusual during that kind of period right after COVID, the onset of it, where corporates were pre-funding 3-4 years in advance. So we've got some time. The second point that I would note on the spreads, and this is a conversation we've been having more with clients, there's this relative value tug of war happening in the credit market where spreads in isolation are quite tight. But for yield-based buyers, the elevated risk-free rate, which has intensified most recently, as you've all been discussing, is giving them some cushion to deploy capital at still relatively attractive all-in yields from a historical perspective. And so, ironically, even though spreads are quite snug, the overall value that's provided by corporate credit, because it's boosted by the risk-free rate, has insulated that to some degree.
How transformed is high yield as an asset class?
Yeah.
Because in some ways, it's the new investment grade, and private credit is the new high yield. We're looking at an entire spectrum of lending below the covers that's taking over and buffering some of the financial pain that we would otherwise might be seeing in some of the high yield names.
That's right. So the high yield universe in particular has had much more overlap in recent years with the investment grade landscape because there's been this fallen angel rising star dynamic that has really intensified. So you've seen names move, I think, a little more seamlessly than we would have guessed in 2018 and 2019 between the two markets. And the high yield market has shown its ability to absorb those capital structures. There have also been some really meaningful shifts in sector composition, the high yield market serving a larger and larger borrower, changes in maturity and duration and sector skews. Energy is not as problematic in this cycle as it has been in the past. Those are all probably contributing to this tight spread environment in high yield. In private credit, we have a very favorable view of it as an asset class, specifically in an environment like this where you can introduce some granularity and some selectivity to deploying. But to your point, the $1.5 trillion asset class is a relatively post-financial crisis phenomenon. And so it makes things like we've looked at in prior cycles, like the Senior Loan Officer Survey, perhaps less directionally correlated into the broader state of the market because you now have this asset class that's allowing corporates to diversify their funding away from the banking channel that wasn't in place to as much of a degree pre-financial crisis. And so when you think about bank lending contraction and that automatically leading to a recession, that may not be the case as much directly this time around because you've got this other source of funding. But as it relates to private credit, I think if you're in an environment where you really need to be granular about companies' ability to absorb higher costs, manage through a higher cost of capital environment, you want to be more selective and granular. And I think parts of private credit, specifically senior direct lending, allow you to do that in a higher cost of capital environment.
A clinic, as always, Amanda, just wonderful. If you are just tuning in, welcome to the program. The S&P 500 right now positive by 0.5%. A little bit later in the program, we'll catch up with Claudia Sahm of Sahm Consulting and former Fed economist going into Jackson Hole and that annual Fed get-together later this week. Can we squeeze one in, Amanda? Just bonus round. Favourite sector right now? Have you got one?
Well, I think over time, the financial sector does look attractive. You were talking about the underperformance recently. I think in addition to some of the cyclical concerns, it might also be regulation and potential refinancing needs coming from the sector. I think once that settles down, that will be a pretty attractive place to look.
The bank's in focus, TK. Going into Chairman Powell on Friday.
Oh, a big focus. They're going into Chairman Powell, but I think it's a lot more than that. It's earnings season and the rest and how they adapt and adjust to interest rates, as Julian Emanuel was talking about, back to 90s. I mean, it's banks back to the 90s is maybe the headline.
Elisa made the point in the last hour, and I think it's a really important one. Yes, yields are higher, and technically we talk about that correlating with better bank performance in the equity market. It hasn't at all in the last month. Demand for loans. Demand for loans is a massive feature of all of this, Lisa, not just here stateside, but also I'd make the same argument for China at the moment. We've seen demand for loans there just, rock bottom. It's not there.
They don't want to borrow at the rates that are the going rates. But to Amanda's point, the degree that they do borrow, they're going to other channels outside of the banks, whether it's private credit, whether it's the public debt markets. And that's creating a real problem for the banks. Where are they going to get that extra yield that gives them that benefit when yields rise?
Amanda, thank you. We need to do this more often, like on a weekly basis, a credit update. I'm not sure you or BlackRock want to do that. It's far too stressful waking up so early Monday in the morning to do some of this. Amanda Lynham of BlackRock there on fixed income. Live from New York City this morning. Good morning. This is Bloomberg.
I think Powell's going to talk hawkish, but when you really listen to the message, I think he's going to agree with John Williams. You know what? We are making progress on inflation, and if we continue to do that, we're going to have to lower interest rates next year. They can't really afford to see this bond yield keep going up, so they've got to calm the bond market down.
It's going up again this morning. That was Ed Yardeni, the president of Yardeni Research. Some comments there on what he thinks Chairman Powell should be doing later this week. Here's the bond market right now, currently. Selling off in the Treasury market. Yields higher by 4 basis points, let's call it. On a 10-year, about 4.29. Bit of news on Goldman Sachs from the Financial Times this morning. Goldman acquired a California-based investment advisor back in 2019 for around $750 million US dollars. It was United Capital. This, Tom, ultimately became this investment advisory business for Goldman. Yeah. This is what the FT is reporting this morning. They are exploring a sale of that business, Tom. The second paragraph in the story reads as follows, that the Wall Street firm said on Monday it was currently evaluating alternatives for its personal financial management business, which encompasses Goldman's registered investment advisory operations and supervises about $29 billion in assets. The stock's up a little bit, Tom, by 1%, 328
in a single
pre-market.
Sentence, its fintech business, Green Sky, that worked out, is also for sale. What this is not about is markets. This is not, the headlines coming out now are a bit confusing, and John, the stock has moved up nicely. I think you're 100% correct. It's discrete to parts of their wealth management business, and it's not the drama of saying they're getting out of consumer banking. It is
I don't think we have to labour
case.
the point.
Yeah.
Just the latest reporting from the Financial Times this morning, Tom, on that front. Elsewhere, more broadly, this equity market's doing okay, up by 0.5%. I don't think we can make the same argument for China at the moment. Hang Seng has just been hammered over the last month. Damien Sassow with us around the table with plenty to say on this, TK, but this is not the market we expected to see in 2023.
There's a lot of log convexity out there. He's got a Hinckley picnic boat that Damien tools around in on a weekend. It's named Log Convex. Everything in your world right now has a suddenly to it. There is an accelerative tendency across everything in the Sassow world. What does that signal to you?
Well, it's a messy transition from inflation to growth. That's what we're seeing. Different economies at different parts of the cycle. I'm looking at Brazil and Chile. I mean, they're looking at growth, and you're looking at developed markets looking at inflation fears. And so, look, the China growth miracle is over, right? I mean, there's no doubt about it. And so she is trying to pull on every lever he can to get demand and consumption back online. It's going to be a non-monetary policy event that's going to have to do it. He's not willing to go there yet. And so we see, as you rightly point out, Hang Seng down 7 straight days. I think all 48 members of the CSI, the onshore Chinese equity index, were down overnight. It's not good if you're an investor in China.
For those that have always given the Chinese policymaker the benefit of doubt, they've been rewarded over the last 10 years repeatedly. Yeah. For those that thought this whole thing would blow up, they haven't been. Right. Do you sense the policymaker in China has control over what's developing? How orderly is all of this?
By the policymaker, you mean President Xi, right?
I mean exactly that.
I don't think he does have control, unfortunately. I think he has his finger firmly on the button. But I mean, in terms of policy credibility, in terms of getting foreigners to invest in China, it's just not happening. If you look at the BRICS conference, what's happening on the sidelines, some of the people I know there, look, you know, Indonesia, Saudi Arabia, they're talking about 20 new entrants into this new BRICS kind of block, this new trade block. But there are a lot of risks there. And India, I think, stands out to me more than anyone. India is pushing back. Obviously, China and India are kind of at a bit of a divide there, you know, for a number of different reasons. But, you know, they think that this block is going to be more of just a talking point for China. It's just going to be a way for China to kind of communicate its own interests globally. And so we'll see if that, you know, materializes. We'll see if some good things come out of it. We'll see if Saudi Arabia and Indonesia, who are applying for membership, receive it. But certainly, you know, I don't think it's anything to give the U.S. great cause for concern, just given what you opened up with today. Real yields in the U.S.
Are you okay there?
I mean, really good. I mean, I've been reading about this stuff all night. I mean, the 5 and the 10-year real yields. I mean, we're talking about all-time highs going back for years and years and years.
But it's massively log convex.
Take what the market gives you. The market is giving you a positive real yield here in the United States in dollars. So, you know.
How connected are these two stories? So you've got growth expectations in China hammered. Nomura, Morgan Stanley, JP Morgan, 4 handles on GDP in China this year. Not so long ago, we'd be talking about cutting expectations in the US off the back of that. Bond markets rally and equities giving up the story, the rally as well. Is it different this time around?
No, it's all linked. I mean, look, let's be clear. We've been looking at carry as the driver of returns this year. Take a look at growth differentials. It's telling you much the same thing, right? So if you look at growth differentials, if you look at Euro and China kind of converging down toward the U.S., I mean, the U.S. is running in the third quarter at about a 4% GDP growth rate with 3.5% unemployment. Talk about the mechanism of monetary policy not working here in the U.S. What that means with that growth divergence is you're seeing, I mean, look, the BOJ is not going to step in and intervene until dollar-yen hits 150. You know, obviously, China's comfortable with the yuan depreciating, albeit not at the quick level we're seeing here. You know, we have Lagarde coming out this week. Euro PMI is probably going to be weak. This is a dollar bull story. You take what the market gives you, and if you're telling me real yields in the U.S. are positive to the extent that they are now, and you might get this kind of, U.S. dollar strength coming off the back of that. I mean, to me, it's kind of a no-brainer.
From a broader perspective, you were talking about the economic divergences. Is China's loss the gain of Southeast Asia when it comes to manufacturing, and also the United States when it comes to certain economic momentum, or is it a net loss for the global economy?
So difficult to tell. I think it's probably a net loss for the global economy. I mean, for me, it's look, you're going to have winners, you're going to have losers anywhere you go. It's difficult to determine whether or not it's going to be Vietnam or Indonesia or Malaysia, the Philippines. It's anyone's decision or anyone's kind of guess right there. I just think everything is really linked here, and it really comes down to currency. So if you're looking for any sort of, I forget who was on earlier talking about, it's the price reaction to how these moves are, it's so important to look at that. How are currencies reacting when, for example, the Brazilian Central Bank cuts rates? How are markets reacting when China tries to stimulate but doesn't go to the extent that the markets are envisioning? And so you see the Hang Seng off 7 days in a row. I think it's the price reaction that matters most.
Damien, very quickly here. We're going to Jackson Hole. We're going to go to London with a great effort there, and then on to Morocco and the IMF meetings. Georgieva and the IMF have a gloom out there 5 years on global GDP like nobody. To me, it's the singular data point of the last year. Dr. Georgieva is talking in Foreign Affairs magazine about fragmentation, geo-fragmentation as well. I don't hear that from you. Are you more optimistic about EM growth than the consensus?
I think Georgieva is spot on. What she's talking about with fragmentation is all of these countries living out along the frontier. I mean, think about who's in the United States just today. We're talking about Massa, Argentina. We're trying to get $7.5 billion out of the IMF because that country's in utter disarray. And if you look at the elections coming forth in October, Milei, who is a bit of a right-winger there, is pretty much leading in the polls.
Why
or maybe
should
second.
the IMF give Argentina
their whole
any
balance
more
sheet,
money?
Their whole balance sheet is exposed to Argentina, or a great portion of it. So they're obviously invested in it or vested in the success of that story. And what's, Sergio Milei, perhaps coming into power. I mean, he is. I mean, some of the things.
Guy?
So I want to tell you about some of the policies he's talking about. He's anti-China. He's anti, quite frankly, any socialist economy. So that includes Venezuela, Nicaragua, North Korea, and he's outward about that. And he's put a lot of the other Latin American nations, Colombia, Brazil. I mean, he's not a fan of Lula.
What's bad about that?
On notice because they're leftists, and he tends to kind of side with the Bolsonaro kind of Trump regime. He's been talking about blowing up the central bank completely, dollarizing the entire economy, even though it is pretty much dollarized already. But these are some sort of extreme things to be saying when Sergio Massa, the finance minister in Argentina, is in the United States today appealing to the IMF for more funds. So these are the kind of idiosyncratic things. We had an election in Guatemala overnight. We had Ecuador, which is now going to be stretched to October. There's an election there that's very, very important. These are large issuers in the emerging market space, and so I think that's grabbing Georgieva's attention.
You need to come back for two reasons. John, you can figure out if we do it pre-Jackson Hole or after. One is you got to come back and talk about dollarization, which I think is the biggest bunch of hogwash I've heard since time began. And the other thing is you got to explain college football as we go into the season.
Georgia, Michigan, Alabama, those are your top three.
It's like nuts. I mean, all the different leagues and...
Why isn't Maria talking more about the Spanish women's team today? I mean, what a win by them. That was wonderful.
We actually asked Maria to join us, and she said she had to travel.
She had to travel.
Gave her the opportunity to talk about the win over England and didn't want to go there, Damien.
Was there enough love from the Prime Minister? I mean, it was in the zeitgeist. To be honest, I didn't follow it. I was
plenty of love.
Focused on
I'm looking
Bayern.
forward to seeing the TV ratings for this game out of England, Tom. I imagine they're going to be really, really high. really high.
Spalletti in Italy. Spalletti.
I saw
Lisa,
taking a management position. Very cool.
Very cool.
Very happy about that.
Yes, it's a good
by the
choice.
Way.
Very good
when
choice.
Mancini resigned, I was worried that it wouldn't be Spalletti, but that's a good thing as well.
You going to weigh in
lost
here?
for words.
Well, no, I think they got a little too much love from the head of the Spanish football commission.
I did not observe
no
this,
joke.
but
It's like, pump the love back.
Saw that picture.
Yeah, not so much.
I watch Harry. I watch every minute.
You watch the game?
I love it. I still don't get, are they as good as the Premier League? And my answer is I don't think they are.
I'm not sure if the league is, but certainly that team is up there. If Bayern Munich was in the Premier League, I think they'd compete for the title.
What was it? I'm sitting there watching it. It's the Allianz Stadium. Mohamed Al-Arian's in row 4.
There's so many
50
Allianz
yard line.
stadiums. Do you know how many Allianz stadiums there are?
I'm like waving at Mohamed. He's like Harry.
Damien, thank you. It's good to see you, mate. Thank you. From New York, this is Bloomberg.
It certainly looks as if third quarter is going to stay pretty resilient.
I'm looking for the market to either move sideways or continue with this pullback.
Now we're trying to assess, is this another soft landing or is this potentially a false signal?
I would argue that the lags are even longer and more variable.
I think we're going to see some chop come back into the inflation numbers.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television on Monday before Wyoming and Jackson Hole. We're leaving on a jet plane on Wednesday. Out we go. A different Jackson Hole, John, this year than what we saw last year.
It's so different. Last year, all about inflation. This time around, inflation and what about growth? This from Andrew Hollenhorst over at Citi with some questions. Here's one question. How will Powell balance optimism about recently slowing inflation with the reality of continued upside risks at Jackson Hole on Friday? And he goes on to say the answer to that, quote, may determine if the sell-off in long-term bonds continues or fades. Tom, that sell-off this morning resumes.
Yeah, and the sell-off resumes this morning, and the answer is, well, the sell-off resumes this morning. I'm looking at NASDAQ now up 0.7%, which gets my attention. But there's a lot of trauma out there. You mentioned Hang Seng in the last hour. What I'm going to mention is data dependency. And all he's got to do is get up and say, I'm waiting for August 31. I'm waiting for September 13th. Can we all move on?
When I say sell-off, I'm in Treasury.
7-minute speech?
Yields up right now by 4 basis points, Tom, on a 10-year, 4.29. People would love it, Lisa, if they could buy that and move on. The question is, can they?
Especially if they look past the moment right now and they say, we're just going to keep watching the data. Is that going to be a dovish message that will only encourage this sell-off on the long end of the curve? This idea that yields will go higher if they're going to be more patient, because that means that longer-term inflation can stay higher for longer.
Damien mentioned last hour, and so did Amanda Lynham of BlackRock as well. The real yield analysis is tangible. We're near 2% in the real yield. That's been the big change, John, since I've been gone the last number of days, is the inflation-adjusted yield is speaking volumes. How is that interpreted? Not so much by the academics at Jackson Hole. How's that interpreted by the PhDs back around the table?
Is that going to do some of the work for the Fed, Tom? Ultimately,
Precisely.
Is that going to crimp growth?
Yes.
Because growth at the moment has been tremendous relative to expectations. I think Mike Gapin over at Bank of America called it on Friday a scorcher. It's been a scorcher. Absolutely. Let's talk about the price action just briefly, Tom. I'll wrap it up for you. Equities up by 0.5% on the S&P 500.
Nice move.
4 days without gains. Maybe we get a day of gains today. And in the bond market, TK, 429.42 on a nominal 10-year yield. Yields higher here by 4 basis points.
And again, the VIX, 17.45. The angst out there is at 20 VIX. And I'm not at a 20 VIX. I'm at 12, 13, 14, back to 17.45. I just don't see the angst out there.
It speaks to correction, which is what you said, Tom, an hour or so ago.
Yeah. Oh, that's what Julian Emanuel talked about. He dovetailed his work in with Ed Hyman.
That's what he thinks it is.
And he's saying, like, there's a churn here. He wasn't too big on the banks, but he said, look, get ready for another leg up at some point.
Max Kettner, HSBC, wants to buy this weakness. Other people, Mike Wilson, Morgan Stanley, think this weakness can continue.
Is it a toxic brew, Lisa?
Yes, it's a toxic brew, but it might just be, slightly toxic that gives you a bad stomach ache for a week, and then you feel fine and everybody keeps on going. And I think that is sort of what some people are banking on. We'll see.
I'm going to look at Euro Yen here, 159.14 to finish out the data check. Right now, to help us out here is someone doing market strategy at Crossmark Global Investments and actually looking at the allocation of portfolios. Victoria Fernandez joins. Victoria, is it a time to reallocate? Is it a time steady as you go? What's the nuance at Crossmark of what to do with a marginal 5% of a portfolio?
Well, I think if you were overweight some of these names that have been doing so well over the past couple of months that actually had been overbought, then yes, you should be reallocating. You should be trimming those names and going into something different. The approach that we've had with our clients all year, as you guys well know, is we have been much more conservative in our approach, assuming that we were going to see the equity market pull back. I think we were talking maybe a 7 to 10% correction from the highs. We're down around 5% now. So having that balanced portfolio, having some value names, having some cyclical names, that's where you should have your portfolio positioned right now. So if you're not there, then it's time to reallocate.
How impatient are your clients that ask, why don't I own more? Pick your big tech name like Nvidia later this week. What's the impatience level that you sense?
We had a lot of that last quarter, obviously, when the big run-up was happening. And so we had to go in and explain what we saw in the technicals along with some of these, where valuations were, where they were so stretched. Now, we've seen valuations come back on that mega cap 7, that magnificent 7, from around 31 times forward earnings to around 27 times right now. So it's coming back a little. They're still rich. You have exposure, but you need to have exposure other places too where valuations make more sense. And I think our clients understand where we're coming from on that.
Do you believe that this is just a pause ahead of something that is a resumed rally or even a recovery trade as people reset? Yes, yields are higher, but yes, growth is coming in incredibly strong.
It's really a double-edged sword when we look at it, Lisa, because you have these growth expectations, which is great. Everyone wants that positive element in your economy, and it helps wages go higher, and it helps the labor market. But at the same time, what do those do? Well, they're telling the Fed they need to continue to tighten financial conditions. So I think it's a very thin line that you have to walk here on these elements. We need Powell to come out. If we want the equity market to settle down and we want yields to settle down and then be able to continue the move higher for the equity markets, Powell has to come out and reaffirm what the dot plots were saying, that there will be cuts in 2024. You know that we were never fans of cuts in 2023. We always said that wouldn't happen. The market's come along to that positioning. But the market wants to hear that there will be cuts next year. And if he reiterates that, which is what the dot plot says, then I think you'll see the longer end of the curve come down. You'll see equities go a little bit higher, and that growth story will continue.
Victoria, are you saying that yields have to come down for the equity rally to resume?
I think they have to stabilize. We can't continue to see this move higher. Everyone wants to see a re-steepening of the curve, but they want to see it with the lower end yields coming down, not the higher end yields moving up. And so, yes, I think we're going to need to see yields at least calm down from where they are, stay where they are, or come lower on the longer end to let people know that, yes, inflation is in check. The Fed is going to cut rates next year. That's what the equity market wants to hear in order to have a sustainable move higher.
Victoria, you are comfortably distant from 5 banks in New York City that basically have the wealth of the world at hand. From the distance of Texas, what are the regional banks? What are the smaller sub-regionals, I guess I would call them? What do the banks we never talk about look like?
Yeah, I think there's some concern here. I mean, you were talking a little bit about it earlier, Tom, when you look at commercial real estate and how large a percentage those loans and other leverage loans are of their balance sheet. It's much higher than when you look at some of the larger banks. So they're much more at risk to commercial real estate and the elements that we're seeing there in that sector of the market. So I would be very cautious. Obviously, the big banks, when you look at those balance sheets, they have large cash positions. They are well equipped to handle any kind of volatility that we see in different sectors of the market. Those smaller banks are not in the same situation. So I would be very cautious there. And if you want to be in financials, I would focus on those larger institutions.
Are you still going into energy at a time where we have seen energy prices increase despite the slowdown in China, but some people say it can't last?
Come on, Lisa, you're asking a Houston girl if she's going to support energy.
I know what you're going to say. I want to hear your answer and your reason for it.
So yeah, we think you need to have some exposure to energy. We know there's some concern about the demand coming out of China, but we also know that that supply element of the equation is being held very tightly by the people that are producing it. And so I think you're going to continue to see prices move higher. You need to have some exposure there. ExxonMobil is actually a name we've added to over the last few trading days. So yes, I think you need to have some exposure there. You don't have to be overweight, but I would make sure you have some in your portfolio.
To the math of the morning, Victoria, if I look at the curves, the convexity that's out there, there's lots of suddenly going on right now. Conservatives want to buy a dividend, get some dividend growth. Can you do that in this environment? Can you do traditional equity analysis given how convex things are moving?
Yeah, I think you can. And not only can you, Tom, but I think you need to. Obviously, when you're looking at your portfolio, you want to have that top-down macro approach, but you've got to go bottom up and look at the fundamentals. You got to look at the technicals that are in there. And that's telling you that you can still go in and there is a place for dividend growth. Look, we have complete strategies that are built on dividend payers. We have global strategies that are built on that. A huge component of our large cap strategy are dividend payers. And it does provide you a little bit of a buffer in a choppy market. And if there's anything that we think we're going to see between now and the end of the year, it is definitely a choppy market, especially if the S&P goes down below the 200-day moving average. We've already gone below the 50-day. So I think, yes, there is a place for that in your portfolio. Make sure you do your homework on those names, though. Don't just buy a name because it has a dividend.
Victoria, just to squeeze this in, when you have conversation with clients and discuss this bond market move, are they running towards it or running away from it?
They're actually running towards it, John. We have a lot of people that are saying, why aren't we just dumping all of our money in short-term T-bills and getting 5.25% and just sit back and let that happen? Obviously, there's reinvestment risk associated with that, so we want to move them out the curve. But we have had a lot of clients put money into the fixed income markets right now with the belief that we're getting to the top end of where yields will be for this cycle, and they'll be able to benefit from that as yields come down.
I wonder how many people in similar positions are filled in the same cause. Victoria, thank you. Victoria Fernandez there of Crossmark. The 10-year at about 4.30. The 30-year, Tom, at 4.43 this morning.
You lose perspective on it. I have. I can honestly say, I can say, okay, I remember this from the 90s, but the answer is we've moved so far, so fast. A 3-month T-bill, 5.43%. What are money market funds going to do? What's the disintermediation going to be?
Victoria mentioned, Tom, the reinvestment risk. How many people want to go out further along the curve to lock this in for a whole lot longer?
To me, there's that. Going out, when was the last time we talked about 3 or 5 year CDs or something like that? But the answer is it's convex, and that means every tick we move out on a 3-month T-bill, people are sitting at home, they're sitting in their office, CFOs, sitting there going, let's go. What do we do?
If you are just tuning in, welcome to the programme. Your equity market, a lift here on the S&P 500, up by 0.5%. The conversation about 18 minutes from now with former Fed economist Claudia Sahm, 8:30 Eastern Time. Tom, great preview from Claudia. We're expecting a fantastic conversation going into what you can expect from Chairman Powell on Friday.
Well, the team did a great job on this, and this begins our ramp up to Jackson Hole. What's fascinating, folks, is we really don't know the attendance yet for Jackson Hole. Kansas City keeps it really underfold, but we'll work feverishly starting Wednesday late to really book that up solid. But we're starting now strong with Claudia Sahm and the Sahm rule, who's looking at the recession granularity around the country, and that's something Chairman Powell's really focused on.
Well, and the cost of inflation at 3% versus the cost of higher unemployment that could have long lags in the economy. And this sort of trade-off is really a theoretical question. When is inflation not that punitive for the masses, including everybody who lives in the country? And at what point does there need to be a higher unemployment rate to bring that down and control it? This is a very uncomfortable conversation to have. Nobody wants either of these things, high inflation or unemployment really creeping higher.
Well, Mohammed El-Arian brought that into his essay in the Financial Times today as one of the ideas here is the theory's work of old, the Phillips curve relationship, the Beveridge curve, and others. Larry Summers in the Washington Post this weekend, same thing. John, are the theories that have been there at other Jackson Holes, are they still in play post-pandemic?
The theory of the last decade pre-pandemic. Are we going back to the old ways? What are we returning to? Is the question you're getting at, Tom. Jeremy Stretch of CIBC on foreign exchange and rates coming up shortly from New York. Good morning.
It is all about global economic growth and how much of the burden can the US continue to shoulder, because China is now a detractor to global growth. That has been the story of this year, is that the US has continued to do well and it's accelerating even though the rest of the world has been very sluggish.
It has been amazing to witness. Can that story continue to diverge? Mohammed Al-Erin of Bloomberg Opinion. Over the weekend, Tom, that's something we were all thinking about coming into this week. The focus still on that. Looking at the bond market at the moment, I want to talk about some levels just briefly. Back in spring, off the back of the failure in SVB, let's bring up the board and, if we can, look at equities in the bond. There we go.
Option.
Thank
it's
you.
an August option.
429.23 on a 10-year, OK? The low post-SVB back in April, 324.77. Yeah. That's 100 basis points to go, Tom, on a 10-year. This morning, 430.
Now, take it out 30-year bank rate mortgage, 7.60%. It's off a little bit from there as well. But again, you've got that acceleration in the mortgage rate. You accelerate that into the housing economy. And that goes back into owner's equivalent rent. Really, what is the guess on inflation right now? And to me, I would suggest it's a guess forward to September 13.
You make me laugh because I just picked up an email of yours that you sent me in the break, and I've only just read it. You're referring to yourself in that Jackson Hole promo as Columbo.
Those of you on radio.
Is that what you're doing?
One of the advantages on radio is you don't get to see the imagery of the three of us freezing last year at Jackson Hole.
I was wearing a Martian suit.
I used to love Columbo.
I'm
That's a great
taking my
program.
winter coat, my fancy black winter coat, because last year I took a wonderful Burberry jacket. It was like, it looked like Columbo with Lisa and John.
Very cool.
John stared at me. Were you in a TV show a few years ago?
I used to love Columbo.
You know what's great about Jackson Hole, though? We're going out. We have all Thursday.
Yeah.
Sort of like to thank you to our team for letting us do that. Lisa's going up the Meriwether Lewis River. With Matt Lloyd and Western anglers, I can't pronounce it.
In a canoe?
No, they wade up and there's rapids on the Lewis River, which I guess is the prettiest river. And you get trout, as Ken Pruitt would say, the trout the size of your leg. This was Matthew Lloyd and Western anglers, whatever.
Pause.
Fish guide.
I literally went canoeing once for an hour during a break, and now I am exploring the entire,
it goes from
Western
Jellystone
United
Park
States,
down to Jackson Hole.
portaging
and
across
like
the
Lewis,
that
it's
is.
Lewis
Yeah, the
River.
Rockies. No, I'm
and
not
there's
doing
like
that.
rapids and trout. And you hire Matt Lloyd for like $2,000 a day, and you catch trout.
Oh, really cheap.
It's unbelievable. Yeah. Have you seen what housing is in Jackson Hole?
It's
ridiculous.
Yeah, it's ridiculous.
You talk about
tens of millions of dollars.
I mean, a starter home is $2 million. It's not real.
Nuts.
And this is important, folks. We're going to go out there, but we understand the geography there is not real, even though the effort by Kansas City leads to some important discussion. Lagarde speaking as well.
So Lisa tells us, yeah.
Lagarde Powell back to back.
On Friday.
As we talk to...
Reported.
Oh, it's reported, so it's not official.
Reported.
Yeah, well, I haven't heard the exact time.
I think it's official.
I think it's official she's speaking. I just don't know the time.
I haven't heard a thing. I don't know.
Her people didn't talk to my people. What we're going to do here and what we're doing on a Monday before Jackson Hole, we talked on bonds to Amanda Lynham of BlackRock. And now you need a foreign exchange brief from the right guy. Jeremy Stretch is with CBIC, a great Canadian bank. He's got a shingle out in London and joins us this morning. Jeremy, I don't know which pair to go to, but I'm going to go to my pro pair, which is take out the dollar, and I'm looking at euro yen buttressed up against 160. I have a 159 print. What does the foreign exchange space off of euro yen say about the stability of the global system?
Well, I think in a broader context of what we are seeing, and I think it was quite interesting listening to that quote from Mohammed Al-Erin earlier regarding the impact of the Chinese economy and the reliance on the US. And I think it is very much the case that we are in an environment where the global growth trajectory is being very much sustained by the dollar. Yes, you may want to take the dollar out of the equation in the short term, although I think it's very difficult in the FX space. But ultimately, well, we are seeing further concerns regarding the global recovery narrative. And I think that will continue to be reflected in terms of the high beta currencies, remaining under some degree of stress until there is some degree of confidence regarding the Chinese recovery story. And that story isn't getting the sort of impetus that one would like, particularly in the context of that disappointing LPR move overnight.
Jeremy, years ago when I met John Ferro, we were at Brasserie Lipp in Zurich having an overpriced lunch. And the answer is Swiss National Bank acted. Now we're seeing the same thing with Euro Swissy, strong Swissy against weaker Euro. I get that. But are we at the point where it's not Argentina we're talking about, but it's major developed systems as they intervene to adjust?
Well, I think we are certainly getting into an extreme environment in many particular pairs. So we are seeing some degree of stress in terms of the broader marketplace. Now, the question is, will there be an intervention to come and stem those moves? Now, obviously, in terms of the yen, we are once again getting to extremes now, not just in the context of euro yen, but obviously in terms of dollar yen, as we get close to that sort of intervention corridor that was evident in Q3, Q4 last year. So I think we are in a situation where we are seeing pressure on many central banks in the context of their currency valuations and the impact that those currency valuations have in terms of their competitiveness or in terms of their inflation dynamics. And in many instances, that is causing considerable consternation. It'll be interesting to see how high on the agenda those sort of concerns become at Jackson Hole at the weekend.
I mean, Lisa, when John and I were having the $200 lunch at Brasserie Lipp, this is like 10, 12, 14 years ago, we're not weak, we're not strong on Swiss franc like we were in 2015. We're pretty much on trend, but we're not two standard deviations out with the stresses that we saw in the Swiss bank system.
Well, just taking a broader view of Europe right now, there's a real question of what that differential will look like. And we're looking out to Friday's speech by Fed Chair Jay Powell. Christine Lagarde is reportedly going to speak at 1 p.m. local time, this according to the ECB. Jeremy, from your vantage point, who do you think has the harder message to give at Friday's Jackson Hole symposium?
Well, I think if you're just looking at those two central bank governors, then I think potentially Christine Lagarde has a harder balancing act to fulfill. In the context of Chair Powell and the Fed, well, they are very much geared up towards data dependence. And of course, there is another round of both inflation and employment data before the upcoming FOMC decision. So he can just maintain a steady as he goes policy for the Fed in terms of looking at that data and reacting accordingly. I think from the ECB's perspective, though, there are obvious concerns regarding the headwinds in terms of the manufactured sector. And of course, that somewhat reflects back to what we're seeing in China, but also we're seeing the service sector under increasing pressure. And we will no doubt see that demonstrated in terms of the flash PMI data that we get on Wednesday. And of course, also, Madame Lagarde will be speaking after the IFO and the German Business Sentiment Indicator. And if that also follows the flash PMIs in terms of detailing a downtrend, then I think the differentials amongst the ECB's governing council in terms of whether there is a need for additional policy tightening will become ever more strained. And I think that's going to really test Chair Lagarde's political credentials as much as her monetary policy ones as we move ahead towards the September ECB.
Jeremy, great framing for the week ahead and the month ahead for that matter, with the ECB set to go first in the middle of September, then the Federal Reserve a week later. Jeremy, thank you. Jeremy Stretch there of CIBC. Coming up in the next hour on Bloomberg TV, about 30 minutes away. Here's the lineup for you. Sumit Samana of Wells Fargo, alongside Lisa Shallett of Morgan Stanley, together with Jordan Jackson of JP Morgan Asset Management. All of that and more, TK, in about 30 minutes' time.
The heart of the matter, and I see this in the triple leveraged all cash fund, which has been it's just been amazing to step into it now, net of fees. And John, Lisa Shallett, there's the conversation I want to hear. I want to understand how Lisa Shallett and Morgan Stanley utilize 5.5% yield.
Do you want a sneak peek? Time to buy, maybe further out along the curve.
Yeah.
It's the view from Lisa Shallett and others.
Extend duration.
Perhaps.
That's
like a flavour, Tom.
Yeah,
just go further out on the curve. Yeah, no, I hear you.
Extend duration.
Nice jargon.
I don't know
Another
what
way of
duration
saying,
is,
like,
but
buy the 10-year.
A little duration, a little less risk, the recipe.
It's like
something like that.
It's like
yeah.
yield immaturity. It works.
Why yields can go to 475.
Exactly.
Stir it all up in a pot. Yeah.
We can iterate.
Something like that. What are you talking about, Brahma? Are you causing trouble?
Yeah, of course. Well, Larry Summers.
Why don't you just name it? Hey?
Bloomberg Surveillance on radio and television. It's an August Monday, and it's nuts out there. There's 8, 9, 10 narratives to go. Jen Bartusch is going to join us here later in the half hour. And Lisa, this is on Retail America. If you look at Atlanta GDP now, it's Walmart thumbs up. We're going to have her on.
Thumbs up, and then you hear what the people who are in the C-suite say, and they say, well, maybe thumbs sideways because people are going to, really, struggle to pay their bills later on in the year, which raises a question. Is this just lowering the bar so that they can jump across it later in the year, or is this really real in terms of pressure on the consumers?
Somebody said in Manhattan this weekend, are there any empty seats in the restaurants? They're all jammed.
It's true. I mean, if it's people talk about how expensive it's getting to eat out. Well, there still are plenty of people doing it. So, clearly they still have the money to go.
Market, a nice lift. One statistic, NASDAQ up 0.7%. NASDAQ 100 with a Monday lift as well. Claudia Samm's going to join us here in a moment. A really important discussion to prepare to Jackson Hole. He's been hermetically sealed for the last 2 days. Michael McKee joins us right now, leading our coverage in Jackson Hole. And Mike, I want to first explain to our audiences the very important process that Kansas invented. First of all, we don't know who's going to Jackson Hole yet, do we?
Well, we have an idea of some of the people who are going because the Fed has announced that Jay Powell is going to be speaking, and the ECB has announced that Christine Lagarde is going to be speaking, and the same with Ben Broadbent from the Bank of England and Kazuo Ueda from the Bank of Japan. But beyond that, in general, the Kansas City Fed holds the guest list until Thursday night.
It's not football players from the Kansas City Chiefs. It's not corporate CEOs. Is it even market economists? Jan Hatzius, Michael Gapin, the bank economists, do they go?
Well, several years ago, they shifted away from the market economists and the bank economists, and it is now largely Federal Reserve and other central bankers from around the world and academics who are presenting the papers there.
What about the question that we were talking about earlier about allowing inflation to be 3% rather than needing it to go down to 2%? Is this something that is really getting traction among the individual Fed members who you hear from?
Not at this point. It's much more of a idea that is gathering pace from the outside. I know that Jason Furman was writing about it, and others have talked about it. The problem for the Fed is that if they sincerely believe that if they said, well, we're going to change our target to 3%, while you could make a case that that's logical, it is also going to tell the markets, well, we're not going to get to 2%, and therefore the markets are going to overreact, and that's a problem. And then you lose credibility because what happens if we have inflation again and we can't get it below 4%? Do we change it higher? There's some question about whether Jay Powell will talk about this whole thing, and of course, in eco-speak, R*, what the neutral level of rates is. And the problem is even if he brings it up, then the markets are probably going to overreact to that. So I wouldn't expect a whole lot on it there, but we might get some discussion in the closed sessions of the conference.
Mike, the importance of a title. The title here is Structural Shifts in the Global Economy at a time where people are looking at the potential for a higher inflation, higher rate regime for longer. Is that your take from this? Because that seems to be what people are gleaning from just the first inklings of what they'll talk about in Wyoming.
Yeah, I think they go below the headlines and the data that they are dependent on for the immediate. I've been saying this for a long time. One of the most interesting discussions that's going to be coming into the fore this year over the next 12 months or 14 months is what happens when we're sort of putting these pandemic disruptions to economic data behind us. Do we have a 3% economic or inflation economy? Do we have an economy that has higher neutral rates? How do you make policy under that situation? And I think the topic is designed to give them the flexibility to talk about all those things without specifically saying this is what any bank is going to do.
Quickly here, Michael, isn't the out here, frankly, for Lagarde as well, and maybe Ueda even more so, although that's a complex story. They're just data dependent, and they have to stagger into September. Isn't that the quickest exit of Jackson Hole?
Yeah, it's interesting because the market only cares about that 8 to 8:30 a.m. and the 1 p.m. Eastern time.
We care about when they walk. Mike, we care. You come out of the Pioneer Grill, chip beef on toast, and they walk out. How many people? There are going to be 4 of them? Lagarde, Ueda,
we don't know.
Broadbent?
It's an interesting question of protocol. Who gets to walk with Jay Powell and what the press calls the perp walk, which drives the Fed crazy. But yes, I mean, for all 4 of the major central bankers there, it's going to be data dependency. And so they probably aren't going to go into detail about their plans.
When Powell points out at the mountains, is he pointing to where you and Alan Blinder were on a cliff once on an icy August day?
Yeah.
Is he pointing? That's where Alan Blinder was with Mike McKee?
Yeah, it's legendary out there.
Mike McKee with us through the week doing a perp walk for us here. Michael McKee in charge of our Jackson Hole coverage. Really, we've got a great team out there to go through the day as well with the governor of the Bank of Japan as well at Jackson Hole. Right now, without question, our economic conversation today, Claudia Sahm has been a leader on monetary economics in America with Sahm Consulting, a former Federal Reserve economist as well. Claudia, what would you like to hear inside that super secret embargoed room that Michael McKee would be in? What is the academic thing that would make you lean forward and listen to the Jackson Hole debate?
I think a discussion of the neutral interest rate, like where people think it's going and what's the case, right? Where are we continuing trends? Are we not doing trends? There's usually a panel discussion in the mix, and we don't learn anything about it. And that one, I would almost bet that that's going to be the R-star panel. Right. And those are really important discussions.
The heart to me is, and this is serious mathematics, folks, the idea, the mystery of becoming anchored or unanchored. If this is the great fear, how close are we to an unanchored U.S. central bank policy?
Well, I think, the unanchored that they talk a lot about is the inflation expectations, right? And to this point, we haven't seen any evidence of them anchoring or de-anchoring. And frankly, things have gotten a lot closer back to normal in terms of, expectations, even in the near term. Now, there is a question if those expectations would move or the fundamentals of inflation would move, then we are in this conversation, is 2% the right number? And that's very much, all of this fits together. Their neutral rate of interest, what's the inflation we should be targeting. I agree with Mike, though, this is not going to be talked about because they're going to hold to 2%. And frankly, I will think they will hold it to the very end.
There's also a question about the lag effects at a time where suddenly the long end of the yield curve, longer term bond yields are actually causing the restriction that the Fed's been looking for all this time. Are they going to openly welcome the move that we've seen, particularly in 10-year and 30-year Treasury yields?
Yeah, I think they've got to be amazed at what finally got markets to believe them. It's like you have the minutes that come 3 weeks after the meeting that say basically the same thing. And it's like, oh, they're going to keep it high for longer. They're going to not cut this year. So it's really fascinating how communication policy works. And, as much as markets want to know how long does it have to stay high to get inflation down, Fed officials would really like to know the answer to that. And that is not anything that's in this. What's the structural global economy shifts? That's, it's going to be data dependent, but you don't get to see into the future to see what the lags are.
Especially at a time where for months and months, we weren't in a high yield environment on the long end. Yes, on the short term, but everyone was basically shrugging it off and saying, we will revert back to where we were before. There has been a shift in tone, but it has been recent, and you have seen financial conditions affected in a more material way. From your vantage point, how much do you think that now we're going to see the restriction that we've been waiting for that hasn't been coming through the market in the same kind of material way?
Yeah, I think the Fed had to be heartened to see markets make a move like on the long end that we're going to be in this for a while. I don't think the Fed looks at this as some structural shift again, and I don't think the market should either necessarily. Like we might be moving in, we might be in and continue to be in a higher interest rate environment. I think it's actually hard to make that case right now. So it's like you want to look out years. Like I think it'll take years for us to get back down to, the interest rates really coming down, the Fed funds rate coming down. But again, I think this is going to be just a topic of conversation for a couple years. Like we're not going to know this.
Claudia, give us an update here into the end of the summer. What does the Sahm rule say right now? What is the granularity of recession in America?
So we're not in a recession. I mean, you don't need the Somme rule to tell you the labor market is incredibly strong. It would be hard in the United States to have a recession called that didn't have a substantial weakening, or at least a trend of weakening in the labor market. Now, I've said a lot of times that, this economy is not the way economies have been in the past. And so, we could have the Fed's forecast where, the unemployment rate goes up to 4, that would trigger the Somme rule, and then it just kind of hangs at 4. Like, that never has happened. We don't go into a recession, but, that would be a great outcome. It's just we haven't seen it, and it's hard to imagine some of these things that have never been seen.
So that's really raises the question, do you think that we could get this benign outcome where unemployment doesn't really creep up that much higher and inflation does come down to 2%? Is that realistic?
I think there's a path to it. I actually don't think it depends all that much on the Fed. I mean, it does. Like, their interest rates are affecting investment. I think the consumers and businesses are less responsive to the interest rates. They got a lot more liquidity, money in the bank than they have before. What has to happen is this disinflation that's coming from the rebalancing, the supply chains getting better, people going back to work, people's spending patterns getting more normal. If those things keep happening, we're going to see inflation coming down. The Fed will back off if inflation comes down. But if the Fed has to do this alone, it's very hard to see a path where we avoid a recession.
Claudia, thank you so much. Greatly appreciated. Great Monday brief here to get to Jackson Hole. Claudia Somm of Michigan, and of course, Somm Consulting, former work with the Federal Reserve as well. We have 8 ways to go here to try to get to retail America. The news flow is extraordinary. And I guess I'm just going to go to what maybe nobody expected. Goldman Sachs out with a note this weekend that maybe the savings is over. But there's a retail boom. I mean,
people have been saying that for so long, right? That the savings are over and that's what we're going to see. And then you had a Fed office come out and say, it's
that's terrible.
They're getting closer still, but they're making more money. I don't know. This is sort of the conundrum because you've seen consumers keep on spending.
We're going to give some retail perspective on that as well. The perspective this morning is a lift to the market. The Standard & Poor's 500 up a good 0.4%.
When we talk about retail, you think about, okay, well, when are people going to run out of money? You're seeing discretionary spending start to pull back in certain places. But in the travel sphere, you have seen a little bit of pullback, but still, what you look at the projections, there have been a number of projections that have come out. Tom, it's expected to continue in a significant way, just sort of a rolling ball of travel plans that go from one place to another.
The travel plans, I mean, are there, and just the basic boom that's out there. When do we forget about NBER recession? When do I get summer stagflation? I'm looking for the stag of it.
Yeah, the stag isn't happening. I'll give you the statistic. This is according to an industry group talking about travel. By 2033, travel is set to become a $15.5 trillion industry, accounting, forget this, more than 11.6% of the global economy.
Well, the percentage there is really important. It's important for New York City, but particularly with the European summer that we've seen. I mean, it's just bigger and bigger. People are moving, and they're moving different places as well.
Well, the irony in Europe that Germany used to be the leader in terms of the economic growth. Now they're flat on their back.
Yeah, flipped on its head.
And the tourism of Spain and of Greece, they've been much more powerful than the industrial arm of Germany.
The big issue here, folks, and we've seen it this morning, are the many narratives that are out there. I'm focused on Euro-Yen 159.15. How unusual. Oil doesn't move, 85.66 on Brent. Crude, as John mentioned, yields on the move up 4 basis points in the 10-year yield. The 10-year real yield, 1.97%. Please stay with us on radio and television on our way to Jackson Hole. Good morning.
I think fiscal policy has actually been more of an accelerant rather than something that has helped to bring inflation down. The administration has been on a very strong spending path, and that tends to increase demand. And when demand is higher, that tends to put upward pressure on prices.
That was Randy Krasner, former Fed Reserve governor, talking about the spending that we keep hearing about, that we keep seeing filter into the economy. and is underpinning a lot of the U.S. exceptionalism that people talk about at a time where a lot of the rest of the world is not having exactly the same story. I do want to just get, Tom, to a number of different stocks that are moving that are notable this morning. We mentioned Goldman Sachs earlier, and this report, well, you know, some people are thinking maybe this is the moment. Those shares up 0.8% after a lot of questions about upward management, as well as some of the turmoil on the inner ranks. The latest is they are looking at a sale of an investment advisory business that it bought 4 years ago. This is one of David Solomon's deals.
Marcus.
Not Marcus. Okay. This is a personal financial management business. The effort that grew out of United Capital in California. They are planning on offloading this at a time.
Credit Suisse?
I'm not sure. I'm actually pretty much sure that it's not Credit Suisse.
Okay.
But this question of streamlining back to the core of what they are at a time when there are a lot of questions around how to create a more fruitful identity.
It's absolutely fascinating. I went back and looked at William Cohan's magisterial one volume on Goldman Sachs, and there was a diner downtown, and they would go in and have egg salad sandwiches, and in the quiet of it, make McKinsey-like strategic decisions for the future of Goldman Sachs. And those days are over. And Mr. Solomon tried to drag them into the modern age. In fact, that was his mandate, to drag them into the modern age. And maybe these are experiments where they go, well, that didn't work out.
Yeah.
And you move on.
And which modern age? Is it the modern age of AI? Is it the modern age of wealth management? And we will, I'm sure, continue to be reporting on Goldman Sachs. The other stock that I really wanted to look at was Palo Alto Networks, which on Friday.
This is cloudy.
Everyone, this is security. This is cybersecurity. Mm-hmm. Everyone was freaking out about them on Friday because they scheduled their earnings to come out after the bell on a sleepy summer Friday, which is unheard of. So everyone expected them to report something terrible. They didn't. They projected stronger billings for the year than expected, and the shares are up almost 13%. And now the CEO is doing a mea culpa.
This week. What do you see?
Right. Well, and then but the CEO is doing a mea culpa, saying, "Sorry, we didn't mean to freak anyone out. We just this was the right time for us to report." Nvidia then coming up on Wednesday, and those shares popping ahead of the open, which is interesting given the fact that they're down about 7%. So far this month alone, trying to retrace some of the 200% gain year to date. So, could potentially have a significant impact.
Thank you, Mandeep Singh of Bloomberg Intelligence, for brilliance there. Speaking of Bloomberg Intelligence and brilliance, there's retail, and maybe from luxury all the way down to big box retail. The leader of our effort, Jennifer Barteshis, joins us right now. Jennifer, what'd you learn from Walmart? I mean, to me, it always comes down to just the Walmart experiment. They're sort of like Home Depot. They lead the way. What did you learn from Walmart that sets you up for back to school and the year-end season?
Yeah, so Walmart posted great results last week. And really, when you think about it, virtually every person in the United States shops at Walmart at one point or another. And so they have a really good read on where the American consumer is at this point. What they're seeing is they're continuing to trade down or seeking value. They're seeing higher income households coming to Walmart more often. But what this really means is that Walmart is particularly well positioned then for the back to school season. They've done a great job of winning share in food, but now the focus is shifting to getting people spending more on general merchandise again, which is a much higher category for the company.
What is your terminal value duration when you study retail, and has it changed? Are you looking out 3 years? Are you looking out 5 years, 7 years? What's the Barteshis view of how far you can go out to guesstimate how they'll do?
Well, I think in retail, because things switch so quickly with the consumer, you really have to realistically look at something in like a 3-year time frame. The consumer, there are lots of things that impact the way the consumer behaves, whether it's internal and their personal circumstances or external. And so a longer time horizon than that makes it really difficult to forecast. But usually things go in cycles. And so what we're seeing right now is a retreat to value. As a consumer feels more confident in their own circumstances, then we'll see that discretionary spending start to flourish again. And when that happens, retailers that are skewed more to that discretionary sector will certainly have their day in the limelight.
Jen, Doug McMillon of Walmart last week said that, yes, you are seeing this boom in retail spending, but and this is how he cautioned it, rising energy prices, resuming student loan repayments, higher borrowing costs, and tightening lender standards, and a drawdown in excess savings mean that household budgets are still under pressure. Is this a true assessment of where their customers are, or is this lowering the bar for them to hurdle across at the next earnings season?
Yeah, so it's a little bit conservative, but I think that we've been through so much with the retail sector in the last 2 years that a little bit of conservatism is probably warranted. But when you look at the average consumer, energy prices are up, rent prices are still up. They have their mobile phone payments they have to make, and now with the resumption of student loan payments, that for the average consumer, average American household, that could put a little bit of additional pressure on spending. So we're anticipating that value-seeking behavior is going to persist through the second half of this year and into 2024.
One thing that I'm curious about, honestly, of all the earnings that are coming this week, we have Lowe's and Macy's on Tuesday, Kohl's on Wednesday. Thursday, we get Nordstrom, Dollar Tree, and Gap. Gap, where is its place in the mid-tier retailers at a time where the two ends are both gaining, whether it's the bargain hunting or whether it's the luxury? The middle is kind of left out.
I think Gap is a great example of where that middle is really where new strategies and tactics are required. We have seen that people who play in value are doing very well. In this earnings season, that has held true. People who are in areas that are of special concern. So you guys we were talking about travel before the segment started. That's still something people are focused on. Beauty is something people are focused on. But when it comes to someone like the Gap, where they don't really straddle the higher end or the lower end, that's where we're really looking for whatever strategy the management team can come up with to kind of reinvent the brand and reconnect with consumers that would be in their target demographic.
Jen, thank you so much. Greatly appreciate it this morning. Jen Bartash is with us here with Bloomberg Intelligence on retail. There are so many stories going on, Lisa. I think we just literally have to stop and reassess. I was out for any number of days here with an illness, and the one thing I followed was the real yield. We began the morning with that. Other people picked up on that theme. 1.98%, a 4 basis point move on the 10-year real yield this morning. I can't convey enough the importance of what that means, how it permeates through the American financial system, almost like a Chris Whalen world. I mean, this is something Chris is expert on. What does it actually mean?
What does it mean? There is a question about whether people are actually gaining income, whether it's a positive for them, that they're getting interest for the first time on their instruments. I will just point that as we've been sitting here, the 10-year yield now through 4.3%, bumping up against those highs, those post-2007 highs yet again, at a time where it's led by the real yield. This is led not by inflation expectations, by something else happening.
Or away from making money in yield instruments like the triple leveraged all cash fund. I mean,
booming.
Pay attention to our new ETF coming October. but the other side of this is to the Neil Dutta world, which is if inflation comes down and my wage growth is still the same, I'm making more money, which gives me a retail oomph. That's another side of the equation.
Which is the reason why people think that retail spending can continue even if you do get some of the savings drawn down, because people are essentially getting paid more. It's a mystery wrapped in a conundrum. I mean, it's an enigma.
Listen to you, how Chicago. I'm back to 2008 on the real yield. I can even go back to 2004 on where the 10-year real yield is now. Julian Emanuel, I thought was great from that. We're adjusting back to a 90s dialogue. Well, we see a 90s dialogue at Jackson Hole.
Part of the problem is that everyone's extrapolating out like we've had these rates for a long period of time, and we haven't. We've sort of tipped these points, and then the longer-term yields have come in because everyone came in and bought them. If they stay here, is that a new level of restriction that suddenly actually delivers the weakness that people are expecting?
Well, delivers the weakness is the missing part over like literally a year that we've been incredibly wrong on Bloomberg surveillance. This afternoon, he's always right, Torsten Slok, Apollo, I believe at the 3:30 hour. Stay with us this week on our way to Jackson Hole.